Well, hello everyone and welcome. My name is Elliott. I'm editor and co-publisher of Energy and Income Advisor, and I'm joined tonight, of course, by my good friend and colleague, Roger Conrad.
Hello.
And we're just going to get started on the webinar here in just a moment, but I'm just going to wait just a few more seconds so some additional participants can log in. I see there's still a number of people coming into the webinar tonight. So we'll just get started momentarily. All right, well, everything looks to have stabilized there. Again, my name is Elliott, and I'm joined tonight, of course, by Roger Conrad. We have on this first screen, which hopefully you can all see on your screen, we've got our contact details. We will open up at the end of this webinar for a chance for you to ask questions of Roger or me if you like. However, you might think of something later on and want to email us, in which case you can use that email address, or you can call us on that toll-free number there. Don't worry, I will throw this up later on at the conclusion of the webinar as well, so you can see that. You should have a copy as well of all the slides that we're presenting tonight. Roger has some slides to illustrate some of his key points tonight. And that web address you see right there is actually an article that we put together just a couple of weeks ago, and it's our overall thesis for oil prices and energy stocks over the next 18 to 24 months. So if you're interested, that's a good website to go to see some of the charts we're going to be talking about on tonight's session. So with that, let me move on to the first slide. Just a little bit of an agenda here and some housekeeping. Sorry about that. This entire interview will be recorded, and we will send a link after the conclusion of the webinar to all registrants to that recording. So if you have to leave early, you know, Roger and I are famous for taking a little longer than expected on these things. So if you have to leave early, run to dinner or whatever, don't worry. We will send you a link to the recorded version of this webinar so that you can watch it at your leisure. We are going to cover what's driving the weakness in MLPs over the past few weeks, why some MLPs are dangerous investments right now, and Roger will be talking about a few specific names to avoid. Roger's also going to be talking a little bit about some of the profit steps he's recommending in the space right now. And finally, we are planning to open it up for your questions as well. We've already received, in fact, a couple of questions via email before the webinar. If you'd like to ask a question, go ahead at any time during the webinar and type your question into the chat box or the Q&A box on your screen, and we'll answer as many questions as we possibly can get to after the conclusion of our prepared remarks of this interview. With that, why don't we get off and start off by, I just wanted to ask Roger to start off kind of the question I think a lot of people are wondering, which is, you know, why do you think MLPs have had such a rough run over the past few weeks? I mean, the Elliott index, which is sort of the industry benchmark, is down, 5% just this month alone. You know, the stock market's been reasonably strong, at least until this afternoon. And oil prices are actually pretty buoyant, or at least not falling. Why is it that you think that MLPs have been so weak?
Well, thanks, Elliott. And first of all, I just want to thank everybody for tuning in tonight and participating in this presentation and then Q&A. And I'm looking forward to your questions afterwards. I think the main what we're seeing here in the MLP space is kind of the second stage of an adjustment period. And and first I have to give you kudos, because I think Elliott, your call to that oil prices back when oil prices were over $100 a barrel, and then fell. I think your target was $25, and they eventually got down to 26 and change. That definitely a lot of pain during this bear market, and in the coverage areas that I look at, particularly the Canadian companies, the Australian companies, and the MLPs as well. We were definitely, based on that forecast, able to avoid most of that first real damage wave that we saw, and companies like Seadrill, for example, really hitting the skids. But a large number of Canadian companies as well as MLPs, and even some of the better run MLPs got hit. So we still had some MLPs riding those down, when oil prices started heading down and gas prices started heading down as well in tandem. And we got down to that low point in the early part of 2016. And, we were in a number of MLPs that were down, but the reason we were staying with them was that we saw them still, again, and this is a theme that you see throughout most of our work, we saw them still pretty solid as businesses in that environment. Well, we started seeing that comeback in the early part of 2016 and on throughout the year. And prices of some of these names that we'd stuck with throughout the period, like Energy Transfer Partners, like Enbridge Energy Partners, Plains All American Pipeline, and so forth. We saw these names really start to bounce back. But what we weren't seeing was a real earnings recovery. And the reason just simply, and this first slide that I've put together here, I think really explains really explains what is going on. Now you can see it the little map in the right-hand corner, sort of loosely describing some of the major shale areas in North America, some of the bigger places where this new technique, hydraulic fracturing in all its many forms, has taken hold and has really opened up reserves of oil and gas that weren't economic at one point. So when we were in that early part of that bull market, and keep in mind energy prices got down pretty far in the early part of 2009. We had seen a pretty major run in oil prices and gas prices particularly following Hurricane Katrina in the last decade, when so much of capacity in the Gulf was wiped out. But we started seeing, again, hydraulic fracturing really coming on and opening up reserves. And that's where we see pretty much all of these lines on this graph. And again, this is just really basic production of oil in these areas. We're not talking about gas, which would be a different graph. But if you look at all these various basins, production going up in all these areas. And then we hit 2014, 2015, not so much right when oil prices started heading down, but then we got into 2015, into 2016, and things started going down pretty rapidly, and particularly in places like the Eagle Ford, which you can see is in South Texas. Now, the exception of that graph is the Permian Basin, and you can see production really picking up and continuing to pick up. And we were, you and I were out earlier this year at a special conference in the Permian Basin where we met a lot of industry executives. We met a lot of people and line people. People were selling products, and then of course there were also speakers on a large number of areas, and it was very informative. And I think that some of these things that we kind of had intuited or you can read about, you can really see in graphic relief what really separates the Permian. And what separates it is basically cost. So as oil prices have started coming down and then reached a bottom, but have kind of found a lower for longer period, some basins, some places where oil and gas is produced have become more and more competitive, and they've been able to drive costs down. And there are a number of features that we talk about in Energy and Income Advisor of what makes the Permian so much more economic than some other areas. But generally speaking, it's because a lot of companies are able to stack wells. In other words, not drill. Drilling is fairly dense, so you can realize all kinds of economies of scale, even in things like water disposal that are extremely important. So companies, by concentrating in these areas, have been able to drive down costs. And you look at some of these other basins, it really hasn't been the case. So why does this matter for pipeline companies? Well, or gathering and processing companies that are the small pipelines and basically, in the case of gas, take the gas off from the wellhead, process it, and then eventually it gets put into larger pipes, and separate liquids are separated out like butane or propane and so forth. Why does it matter, the drilling activity? Well, simply because if you're in an area where drilling activity is rising, there's more and more demand for your equipment and for your services. And that all pipelines that are basically taking the oil and gas and liquids and so forth out of these regions like the Permian, like the Bakken, like the Marcellus, which is more of a gas, basically Marcellus and Utica are basically natural gas reserves. So, they are, but all these companies depend on what's called throughput. So what we've seen here, and this graph really makes this point pretty clearly, midstream companies that operate in the Permian, and when I say midstream, and this is what we basically own with these MLPs, or companies that own pipelines and gas gathering and processing assets, storage. These are called midstream assets. So they are more valuable right now in places where drilling activity is going up. Now, why didn't we see an immediate reaction in some of these things? Why have some of these MLPs taken this long to begin selling off? Because obviously, or to hit this new phase of selling off, because obviously oil and gas prices have been coming down for a little bit. Well, one reason is because a lot of their pipelines and so forth are contracted and have been contracted for multi-year periods. And what we're seeing now, and particularly this is going on in the Eagle Ford with a number of names that I'm very concerned about right now, contracts are coming off. So these contracts that have preserved cash flow over the past couple of years, now this big drop in throughput is starting to catch up. With them. So when those contracts come off, one or two things is going to happen. One, they're going to renew the contracts, but at a much lower rate. Or two, they're just not going to be able to rent this capacity, which is basically what we're talking about. So even these very steady, what have been very steady long-term revenue streams coming out of these areas for midstream companies are now starting to drop off. So what we're seeing all across the space, and particularly in some of these names that we've got and frankly, we got too comfortable with as well, but names that people have gotten very comfortable with over the years, suddenly we're seeing their assets not so much used. We're seeing the rents go down on them, the contracts come off, the cash flows drop. And when that happens, there's only one thing that, the easiest thing anyway for management to kind of right the balance is to quote unquote right size the dividend. And we heard these words all over we heard this right size theme quite a bit at MLPA, and we shared our findings with our Energy and Income Advisor subscribers, just as we did in a special report following the Permian Basin conference that we went to. But volumes coming off, and simply that with a lot of these companies, they just have too many assets in these areas where the basic demand for their services, for their infrastructure, for their equipment, for their facilities, pipelines, and et cetera, is dropping. So, you have this situation now, I think, where a lot of these household names, or these names that we got comfortable with, names that when you and I started our MLPs only publication back in 2009, that was a totally different time. But energy prices were pretty low. We were kind of at the beginning of this stuff. And a lot of these names did really well for us. Well, now maybe they expanded too quickly. Maybe they have too many assets in places where drilling activity has been dropping. But the bottom line is cash flows are now contracting. You see it in coverage ratios which compare distributable cash flow, which is basically the operating cash flow less what's called maintenance cash flow, whatever is needed, maintenance capital spending rather, what's needed to keep the assets running. So we've seen more and more shortfalls in that coverage ratio. There's a lot of debt that was taken on to build assets back in the boom period, and particularly some of the companies like Genesis Energy, which again has just recently cut its distribution. Basically, when we were recommending it back in 2009, they were raising their distribution by an annualized rate of 10% a year, and it made a lot of sense back in those days. But I think they got under pressure to continue at that rate, and as a result, they wound up with a lot of underperforming assets. And again, they've cut their distribution just recently. So, again, kind of a long answer to the question of why MLPs are coming down. But I think right now people are starting to look at the group, and people throw the good out with the bad when they turn on a particular sector. And I think seeing distribution cuts at companies like Genesis Energy, or companies like Enbridge Energy Partners, or Plains All American Pipeline, or Williams Partners, or Energy Transfer Partners, seeing these kinds of names that people got very comfortable with during the boom period start to reduce distributions has made people want to get out of this particular sector. And you see it in real graphic relief in some of the big ETFs like the Alerian, that are based on the Alerian index. Those investors who own those MLP, those ETFs that are based off of those indexes have definitely felt the pain, because you look at what the components of those indexes, they're pretty heavy into Plains. They're pretty heavy into Energy Transfer Partners. They're pretty heavy into the names that have reduced distributions. And again, this is the kind of environment that is very dangerous for investors, but it's also the kind of environment where I think there's a lot of opportunity. But basically, this is what's happened here, and I think we're still going through this adjustment phase, and I think we will see more distribution cuts. I think we'll eventually see a bankruptcy or two in this sector. There are a couple of pretty good candidates for that right now. So, a lot of people talk about, well, can we make an adjustment, of our portfolio because I've made so many distributions that my taxes are going to be high. Well, I'll just say it this way. I think if you just look at the record so far, it's made a lot of sense to book those gains, even if you were only getting back 80 cents or 75 cents on the dollar. In many cases, it's a lot better than simply writing something down and giving up 100% of those gains. And you look at a name like Energy Transfer Partners that about a year ago trading pretty close to 30. Right now it's about 17 bucks. I know a lot of people didn't want to sell it up there at 30, but and it paying taxes on that $13 that you would have saved by selling it. Again, if you didn't sell it, you lost the whole $13. If you did sell it, you lost, or you at least were able to pull down about $10 on that. So again, that's a kind of a unique thing with the MLPs, but I still think that even with the taxes, it really does pay to be very careful, with these names, and to come out of the bad names and come into the good names. Because as you can see from this first graph here, with the Permian and drilling and so forth doing very well there, as opposed to these other regions, it still makes a lot of sense to move into those better names. And I think the next couple of slides may talk about that, make that differentiation.
Yeah, absolutely. The next slide here that you sent is, I think, really important. I mean, this is kind of the genesis of this entire webinar that we're hosting tonight. Last week we were talking, and I believe, Roger, you'd just spoken to an investor group, and you'd gotten a lot of questions about master limited partnerships, of course, as always, high yield group. But you also got an awful lot of questions about some of the names that you think are actually the most dangerous names to own right now. And I've certainly had that experience in talking to readers at various conferences and communicating via email and on the chats we do with our subscribers every month. And Energy and Income Advisor, it just seems like we always get a ton of questions about these older MLPs that own a lot of assets in some of those basins that just aren't seeing much growth. And I mean, this next slide, I don't know if you want to just kind of explain this, but there's some MLPs which are doing a great job of adapting to this new environment of regional production growth in areas like the Permian Basin, and others that are kind of still stuck in the past with legacy assets that aren't gonna perform well. So I don't know if you just want to sort of explain some of the key things you look for names that are adapting versus names that aren't.
Yeah, absolutely. I think one thing that's really become clear to me from, and again, a little bit, this is 2020 hindsight, but the companies that didn't grow or didn't try to keep up with with their rivals or keep up with the Joneses in the MLP universe, that just maintain kind of a steady growth trajectory, maintain conservative finances and so forth. They weren't really the popular names back in the boom times. And in fact, they didn't really, they weren't the ones that paid the huge yields, and they weren't the ones that had the massive gains. Names like Enterprise Products Partners, which again, really steady long-term name and they really didn't try to accelerate and, pay 10% dividend growth. You really got a sense of what companies were doing being at some of those MLP conferences, particularly up near the peak for this market. And companies were just competing. And I admit, listening to presentation where they're talking about how they're going to grow their distribution 10% a year is a lot more interesting than listening to a company growing 4 to 5%. But this has been a real differentiator. Companies that just maintain kind of a steady approach. They were able to focus on the best customers. They were able to focus on the best products. They were able to projects. They were able to focus on the best reserve basins, and as a result, they're far healthier right now that things have kind of settled into this lower for longer period where not every basin is doing really well. Even though production has dropped in places like the Bakken, there's still midstream companies that have been doing pretty well all along, and that's just because they were in the better parts, they had the better customers, they had the better contracts, and other companies came in there, tried to take advantage of, maybe some of the production increases that were coming because we were at $100 oil, and this is kind of what you had to do if you were trying to keep up that 10% annual distribution growth, again, it just boils down to having a more conservative approach is serving companies much better now that things have cooled off a little bit. Assets in better basins, I pointed some of those out on the last slide. Those certainly aren't the only group. In fact, one reserve area that has really come on strong, and we were out there about a year ago in central Oklahoma. It's called the Scoop and Stack, and this is a very prolific area where drilling activity is going up, and it's really benefited one of the names, which I'll talk about in just a minute. It's really, in fact, turned them around from the kind of company I'd want to avoid to the kind that I'd want to own. Assets in better basins, you really can't overemphasize how important that is right now. The strugglers, pretty much what you find is the asset mix is kind of a hodgepodge, where the laggard assets are dragging down the leaders. Energy Transfer Partners, if you listen to their conference calls, they're going to talk all day about how the new projects they have that they have in the better basins, and that's legit. They have some very good assets, and they're going to continue to grow those assets. The problem is, though, they added so many other assets that it's really hard to tell what exactly it is that they have in total. So what you can see, though, is the coverage ratio continuing to drop, and what that's telling you is that distributable cash flow, or operating cash flow less maintenance cash flow, what they're taking out of the business is continuing to drop relative to the dividend. So again, this is something. It's kind of a slow motion train wreck for a lot of these companies, and it's one reason we really recommended selling most of these as the prices came up, and now we're starting to see the downside for a lot of these household names. Again, the converse for the adapters is they have few of these assets. They're much more focused on better basins, better customers, better projects, and so on. Balance sheet's really important, and debt, we talk about this a lot too, but nobody really cares much about debt when things are booming. When people start seeing an environment tighten up and capital gets a little bit harder, particularly as what's happened with these MLPs, we've seen it get a lot harder for them to raise equity, to sell units of the partnership. Because simply the unit prices have dropped. And Energy Transfer Partners right now just hit a 2-week low today, and this is a name that actually the damage is worse than it looks, because they did what we call a stealth dividend cut by merging what was the old Energy Transfer Partners in with Sunoco Logistics, and that involved an implicit 30% distribution cut. So that drop is actually a lot worse than it looks. And again, this is because this company has a lot of these other assets. It expanded very rapidly, and it has a lot of debt. So again, it's getting more and more difficult to service. And this is a name that I think we're going to see another distribution cut. But again, a lot of their problem is they tried to grow too fast in the boom times, and they have very high debt hangovers from the party. Whereas some of the other names, good balance sheet, good access to capital, still many of the names actually, the lower debt names actually have no problem raising equity right now because their unit prices are in good shape as well. So again, we're in that kind of period here in the market where and in the energy price cycle where it's critical to have a strong balance sheet. And if a lot of these MLPs just simply have a lot of debt coming due at a time when cash flow is weakening. And the adapters can fund what we're seeing a trend with some of the better MLPs is that they are starting to fund most of their capital spending, at least the part that they have to fund with equity. They're starting to fund that with their internally generated cash flow. So, not only are they not in trouble in terms of and they have modest amount of debt and they have strong balance sheets, but now they're able to avoid issuing new shares. So as they're growing those cash flows, that goes directly into what they can distribute to the shareholders, or they can cut debt with it, or they can make acquisitions of assets. It's really a virtuous cycle, which when you look at the struggling MLPs, the exact opposite is happening. And the further their share prices go down, the more critical it becomes to refinance their debt portion by rolling over their debt. And we're starting to see the cost of that debt rise. The best measure of that cost of debt is what's called the yield to maturity, and that's just basically the return for an investor who would buy a specific bond right now. What would be their return to when that bond matures? So that would be the dividend yield, the interest paid plus whatever price movement to get that back to par. We're seeing those yields to maturity really widen out, and that means that it's going to cost in many cases more for those companies to roll over bonds than what they're paying in interest. So that's yet another burden on cash flow that takes away from what can be used to pay dividends. So again, it just comes down to the best road ahead for many of these companies is still going to be cutting distributions. And in fact, even some of the companies, even some of these MLPs that have cut already are very likely to cut again, or right up at the top of the list to cut again. And
in fact, we've already seen that with some of them where they've cut 2 or 3 times over the last couple of years, which is kind of like death by 1,000 cuts. Yeah,
absolutely. I mentioned that some of these MLPs even are bankruptcy candidates. A company that I don't even actually have on the as we go forward on the slides, but now occurs to me, Feral Gas Partners, and they're fundamentally a propane distributor, not a super fast-growing business, but a real steady one. But what this company did under some very poor management advice, went out and bought some midstream assets. They bought a water recycling business at first, or actually not water recycling. It's basically a water disposal business in the energy patch where they truck away large volumes of water and dump it into disposal wells. So this business really dropped off a cliff when we started to see drilling activity drop off, and were pretty active in the Eagle Ford, for example. Then they went ahead and compounded their problem. They bought a company called Bridger, which contained a lot of what is called supply and logistics operations. And this is really the murky area of the midstream business that we've seen also a lot of these MLPs get involved with. And it just is basically marketing and so on. It's very hard to get visibility on where exactly cash flows come from. They tend to be very, very, very volatile. And this has killed Feral Gas. So they've you mentioned, multiple distribution cutters. I mean, they pretty much did all their damage in one fell swoop. Their dividend went from a little over 51 cents, actually 51 and a quarter cents, to 10 cents. And I think this is a pretty good prospect to see this thing really zero out going forward. And again, right now it's a B3 rating from Moody's. It's a negative outlook. It's CCC plus from Egan-Jones, and which is borderline bankruptcy. I think this is one that could go all the way. And as we've seen with some of the MLPs that were organized as producers, like Lynn Energy. And again, I credit your call on oil prices for us being able to get out of that one at well above before it eventually went bankrupt. But investors in MLPs, and this is fairly scary. If you invest in an MLP that declares bankruptcy, you might wind up not only losing your entire equity investment, but you might wind up owing taxes on that investment as well. So I think we're going to see I think we will see some bankruptcies. I think we're going to see a lot more dividend cuts. And again, it just comes down to the fact that sort of a hangover from the boom times and an adjustment process that while there's tremendous opportunity, there's tremendous risk. And, I go back to a lot of these names that we keep getting asked about. I mean, these are names that when we started writing about MLPs, and again, that's like 2009, right after the bull market or the bear market ended and early part of the bull market, a lot of these names were really great ones to hold. Genesis Energy Partners, really a great name, because for a long time, despite that distribution growth, it was chronically undervalued. Well, one thing you find, and even in the utility space, you see it. Companies aren't buys forever, and sometimes companies get into trouble, and the most frequent reason why companies get into trouble is they over leverage, they overextend, and then something comes around and smacks them. And unlike utilities where you do have regulated rate base and so forth, that really, as long as they can fall back on that, they're going to be okay. And when you come to the midstream space, and I think many of us fell into a trap a few years ago of thinking these things were really just utilities or had a lot more utility-like characteristics than they really do. And there are some names that do have very utility-like characteristics, but a lot of this space, not so much. And they're only as good as those contracts and the creditworthiness of those companies on the other side of those contracts, or what we call counterparties. And again, tremendous risk in a lot of these names that I think a lot of people bought a while back and got too comfortable with, and have probably watched them come down, and now are thinking, well, what should I do with them? Well, they've come down so much, they can't come down anymore, and really expecting them to act like utilities, bottoming out at some point. And again, these aren't those assets. Those aren't that type of assets. And if you're in an area of the country, or if the company has a big pipeline, and we saw this with Boardwalk Pipeline Partners, even before energy prices started coming down, they were transporting a lot of Rockies gas east and under long-term contracts. And what we saw with the development of the Marcellus, with the development of the Utica Shale, is very cheap gas in the Northeast, in the Middle Atlantic, in the Southeast. They didn't need that Rockies gas. So all those companies that purchase capacity on Boardwalk pipelines under long-term contracts, a lot of that throughput died on the vine. And then when those contracts came due, the company's cash flow really just dropped off a cliff, and they basically had to gut their dividend. Now, again, that was even before energy prices started heading down, but I think that's a pretty good case of what can happen if you're in if an MLP has assets in the wrong basins and they need to adjust. So I've said this, I can't really overemphasize this. A number of companies are still extremely vulnerable, even though they've dropped off and they're not utilities, so there's no spot where there's no guarantee they're going to come back from this even. I do think a lot of these names will come back, and I think they will be buys at some point, but at this point, they're going to, in order for me to get excited about an MLP as a buy, it's got to prove that it has adapted and that it has these characteristics on the left side of this slide and not the ones on the right-hand side. So I guess, maybe we want to talk about some specific names now, or? Yeah, so this next slide, this is, I've got a pair of slides here, rather, and these are comparison graphs from Bloomberg. And what I wanted to do is just show you first a group of names that have adapted and how they performed in the market over the past year or so, and then show you a group of names that haven't done so well. So this is the group of 4 names. This is a comparison graph. So it starts out in September of 2016, and what it shows you is the total return for these names. It kind of graphs a rolling total return for these 4 names. Now 3 of them are kind of down together, and you can see quantifiably the percentage total returns and price changes at the top of the table. But 3 of the names roughly performing in tandem. Magellan Midstream Partners, Enterprise Products Partners, again, really solid blue chip names. Enable Midstream Partners, this is a name that I didn't like up until recently, but we have included that. I'm going to talk a little bit more about that in a minute. And then the other one there is a company called Noble Midstream. And why has this one done so well? Well, look at this one. And this is this graph actually starts when Noble went public, and you can see it's been a fantastic performer at a time when the average MLP has really done very poorly, as we'll see on the next slide. But Noble has done, again, extremely well. Why is that? Well, the bulk of its assets are serving the Permian Basin. So people have looked at this name and said, how can I get involved in the Permian and not have all these legacy assets? Well, this is one name that's been able to do that. And this is a name that we actually became aware of at one of those MLP conferences. And again, it's not a lot of people have heard of it, but in this kind of changing of the guard in terms of MLPs, this is a name that I think you're going to hear a lot more from, because in the MLP universe, success begets success. And we saw this with a lot of the names back earlier in the decade, some of those names that we recommended back in 2009. The more successful they were adding assets, the more their unit price went up, the more they could raise their distribution, the more their unit price went up, the more they could finance, so the more they could grow, so the more they could raise their distribution. Well, Noble has that virtuous cycle going right now, and even though it's a very young, a very new MLP, it's done extremely well so far. It's a little bit of a rest from where it is right here. So, but again, this is an example of how it's not the MLP structure, it's not the MLP sector as a whole that's suffering. It's that list of those MLPs that are not adapting. So the next graph is going to take a look at some of the names that aren't adapting, and this is a one that the most recent one to cut distributions, and this is Genesis GEL. When you and I recommended it for the first time, I think it was back in 2009, and this graph doesn't go quite back that far. This is only a 12-month graph. But at that time, again, coming out of the crash in energy prices and so forth, and adjusted for splits, this name, or just looking in terms of current price, got down to about $8 or $9, and great time to pick it up. And in fact, you're still ahead, even though this thing has come down from the 60s down to where it is now here in the low 20s. But this is a name you probably want to be a little bit careful with right now. You've got just had a pretty massive distribution cut, which should make it a little bit easier for them to pay that distribution. It should make it a little easier for them to meet their capital spending needs, take care of their debt. They do have the luxury of not having a significant amount of debt due until 2021. But then you get to 2022, you're going to have a pretty massive amount of debt, pretty close to $2 billion coming due. So it's still pretty debt heavy, and this is a work in progress. But Genesis, for a long time, raised its distribution. It was a name that people hung their hat on. I think you and I pretty much soured on this name. It's been the last 2 or 3 years. And the main reason just being that it just seemed to be running out of gas. They were kind of telegraphing that with slower distribution growth, but the deals that they were doing, the assets they were picking up, really seemed to be more directed towards maintaining the dividend growth rate rather than any kind of running any kind of rational business. So again, this graph I think tells the tale of what's happened with this name. It's not it's not the total decline in this thing, but it's certainly the last and most unkind portion of it to unit holders, and particularly with with the distribution cut. So that's a sad tale of woe and a name that we liked a lot. We have not been very sanguine about for quite some time, and for simply the reason that we didn't feel this name's adapting. So I think if you still own this thing, probably most of the damage is done. But the company's got to prove itself, and I think there are other names out there that are in a lot better shape, and I think will do a lot better for investors.
Well, great, Roger. Can you hear me okay?
Yeah, I can hear you fine.
Oh, I apologize. Apparently we had some technical difficulties with my line, and I kept getting kicked off, and but it seems like you progressed through the slides on your own quite well.
I
so
filled up the space, filled up the airtime.
Right. Yes, you did. Never something we have trouble with. And I know the next name you have here, this next slide you have, is actually a name that that you like, and it's also a name that you alluded to earlier in the talk when you were talking about the scoop and stack field of central Oklahoma that we visited about a year ago at this time, right before Halloween a year ago. And I think this company was the one that said, that asset just literally materialized beneath their feet in that area. I don't know if you want to talk a little bit more about Enable here.
Yeah, definitely. I'll talk about it. This is a name that I actually did not like at all up until really till we were out there and meeting with management. And the main reason was that this is a MLP that came about because two utilities, CenterPoint Energy, and which is CenterPoint there is the main headquarters there is Houston, so a lot of people know it as Houston Light and Power. And then the other one, OG&E, decided to combine their midstream assets. And in retrospect, it became something of a hodgepodge of old assets. And in CenterPoint's case, their ulterior motive was basically just to get out of that business entirely. I won't go into the history of the whole asset base, but just briefly, those CenterPoint assets that came into Enable, a number of those were part of what was the old NORAM, and before that, part is ARCLA, and not a real. They have a great reputation as a well-run pipeline company, but a lot of these assets were really old. They're or at least operating in areas that where people have been drilling for a long time, such as central Oklahoma. And so when we came into the downturn, this kind of hodgepodge portfolio, and they had some new projects they were trying to get on up in the Bakken, which most of which didn't work out as much as they would have liked them to. And so they had to stop raising their distribution, and a lot of people, that's often a pretty good sign that a cut is ahead. So when you got into that bottom period, early part of 2016, this stock was down considerably in the single digits. But what happened then was basically some new blood running it. But the main thing, like you just said, this scoop stack happened, and it's a part of central Oklahoma. Again, people have been drilling there for many years, decades, and this was a new technology that has made a lot of reserves that were formerly uneconomic, inaccessible, very economic and very accessible. And so we're seeing this drilling boom happening there. And now Enable is starting to benefit from that. So they had a lot of assets that, in these areas, and, not only the Scoop Stack, but also the Haynesville, and that is a little bit east of there, and a lot of gas going on there. But these areas where people had kind of given up on, I think, because they moved on to other areas. So you had a lot of capacity on their gathering and processing assets in particular that was unused, but also their pipelines and storage assets that suddenly became very heavily trafficked, very heavily in demand. So we've gone in the past year or so from where you've seen a lot of these assets just if they weren't contracted, or even if they were contracted, lying fallow, to being full and now being expanded, and the company's seeing new contracts and is making acquisitions. They just made an acquisition in early October, a company called Align Midstream, and that is in the Haynesville Shale. So what's the underlying story here? Well, that's all, and that's all bullish, and I think we've seen that in the share price. But we think that there are a couple of things that can really take this thing back up into the low 20s and even higher, back where it was when it was actually spun out. One of them is simply that there's all this activity, this expansion. We're going to see more cash flow, and we're going to see this company, as a result, being able to resume regular distribution growth. And management has already pretty much alluded to that, it will be making an announcement sometime. In fact, in the earnings call following the second quarter last summer, the statement was that at the latest they would be making their 2018 distribution guidance. At the latest, they would do that with their third quarter earnings call. So the third quarter earnings call is actually coming up November 1st, and I'm looking forward to that with a great deal of anticipation. I do think they will announce some sort of clarification, at least, if not an outright distribution increase, as they return to a policy of regular distribution growth. And again, this is just simply that their business is getting a lot healthier. They're starting to see those throughputs. They're signing those contracts. And as a result, they're as profitable as they've ever been. And a lot of it's just happening right there in those core areas where they already have all those assets. So, and there are definitely other areas of growth as well. So I think they will. I think odds heavily favor they'll announce a return to distribution growth. We've seen that be a substantial upside catalyst for companies, for midstream companies, particularly MLPs, in past years. So that's a good candidate to push this to into a new trading range. The other thing, and probably if there's anything that could mute the impact, the favorable impact on Enable Midstream of a distribution increase, it is the uncertainty regarding what CenterPoint wants to do with its share of Enable Midstream. So CenterPoint, is part of, I mentioned that it and OG&E had created Enable basically by pooling their energy midstream assets. OG&Es were under a company called Enojex, and they merged that again with the assets of CenterPoints, which were mostly part of that old Arkla NORAM universe. And they are, as a result, OG&E owns a pretty big chunk of the common units, and they own half of the general partner interest. CenterPoint owns half the general partner interest and over 40% of the common equity. So what they've been saying, and they've been basically saying it the last couple of years, they want to sell. They want to, in part, selling their share of Enable would enable them to, sorry, forgive the pun, to reduce reduce debt and become a lot more attractive as a merger partner. And that's CenterPoint has kind of made that clear that that's what they see as the next step for the company, is more or less shopping themselves. So what that has created is a lot of uncertainty in the marketplace about how they're going to dispose of their Enable shares. They've been trying to sell them to OG&E for really, again, since the stock bottomed out. OG&E, I bet, would probably wish that they had made that deal. They are a smaller company than CenterPoint, though. They would probably need a partner to come in. There are other potential players out there to be the general partner or to buy that other general partner interest. There are 40% though of the common units is a lot, and it would take them very long time to sell those on the open market. But of course, that's what everybody's been concerned about. So what I'm looking for here is for CenterPoint to provide us some sort of clarity on what they're going to do with their CenterPoint shares. That's what everybody's looking for in this name. If we get that return to distribution growth, again, coupled with this nice moves that we're seeing and so forth, in their volume and so forth, if they can get that distribution increase, they can keep showing those nice results, and we get some clarification on what CenterPoint's going to do with its limited partner and general partner interest. I think we can really see this thing take off. Until then, it's going to take a little patience, but one of the things that's actually not on this slide, just to be aware of, this thing yields well over 8% right now. So it's a pretty good story for a company that really does pay you to sit there and wait with it. And if they do return to distribution growth, that 8.5% that you're getting right now it's going to grow pretty quickly to 10% plus on whatever investment you made in it. So this is the kind of name that I like in space. I think screaming bargain at us. I think it's one reason that it really hasn't picked up is again, I've mentioned the CenterPoint situation, but also just the weakness in the MLP space in general has kept it down, and that's the time when you want to get involved with these things. So one thing that's really remarkable, really, about the MLP space and is just the fact that a lot of these things have been coming down at the same time oil prices have been rising, and I think again that just shows you the volume situation, how that is really the critical variable here, not necessarily the price of oil. Certainly if you got to $100 oil, a lot of these basins where some of these weaker MLPs operate would start booming again, and you'd start seeing their throughputs rising as their pipelines fill up, their storage facilities fill up, cash flows rising, and so forth. And that's what happens when you're in a good market, at peak of bull market. But we're just not there at this point, and again, we're going to see adjustments in some of the weaker names. It's really important to be selective. You don't want to be as a long-term holder in these ETFs that are mirrored off these big indexes, because they just own too many of these names that have these legacy assets that are overextended, that have too much debt, that are in danger of cutting distributions again, that are in danger of seeing a lot more downside. And to the extent that these ETFs have these newer names that are winning in the changing of the guard in the MLP space, they're just not big enough to really have any impact on your returns. So if you want to trade the AMLP or that which is the largest ETF, that's fine. But this, now more than ever, you don't want to be in MLP ETFs as an investment. You want to be in the individual names that are ready to shine, and you want to be shed of one of these former household names, many of which, again, that were definitely on our buy list back in 2009, 2010, 2011, even, and even before, even as much as recently as the last couple of years. you want to be in these better names and out of many of these names that we unfortunately got many of us got really too comfortable with. So that about sums up that prepared remarks, I guess.
Yeah, it does. In fact, I was going to ask you about some specific MLP names, but I think you covered all the ones I was going to ask you about. I actually went through every month for Energy and Income Advisor. We host an online chat where subscribers write in about questions about stocks or the market or oil. And I just kind of went through the last 3 chats and selected some of the most commonly asked about MLPs. And I really think you've covered all of them. In addition, we have a number of questions that have already come in via email. Some of you have already sent in questions on the chat function on your screen. So in just a minute, I'm going to go ahead and turn it over to you, the attendees, to ask any question you'd like of Roger or me, if you wish. Right before we do that, though, we are offering a special way right now for any attendees of this webinar, just for sitting through and listening to us tonight. We really appreciate it. We are offering a special deal on Energy and Income Advisor, which is our flagship newsletter that covers the energy sector as a whole. We cover everything from master limited partnerships to regular oil and gas producers, even some energy technology type companies as well, alternative energy. We have a heavy focus on income. Roger has a separately managed international income portfolio as well. Normally we offer a 30-day risk-free trial on Energy and Income Advisor, but through this website, through this webinar, and the website I'm going to show you in just a second, we've extended that to 60 days. So you're welcome to sign up for Energy and Income Advisor using either our quarterly option at $194 every quarter or our annual option at $649 a year. And you have 60 days to try it. If you don't like it, if you don't think it's worthwhile or worth every penny of that price, just cancel your subscription. We'll send you a full refund, no questions asked. We're so keen on making sure that everyone who's interested in energy is in the right energy stocks. We think there's a tremendous opportunity, not just in MLPs, but in the sector more widely. But there are also, as there always are at the bottom of a major, at the start of a major bull market, there's a lot of junk out there. There's a lot of names that we think have a lot of challenges ahead of them. And we're really concerned, both of us have become really concerned that a lot of individual investors may be buying the wrong stocks, the wrong MLPs that are being hurt by a lot of the trends that Roger just discussed. In addition, with that subscription, we do have every month a question and answer chat. It's a little different than the webinar we're hosting tonight in the sense that it's a text-based chat. We will send you the website to log in on. You can ask any question you like on the chat, and Roger and I will answer your questions in real time. We've had, I believe the record was 12 hours, Roger, that we were online almost answering questions?
I think so, yes. So in a busy market, there are a lot of questions. So we do believe strongly and we promise to stay on and answer until they're all answered, basically. So, and
we've stuck by that pledge over time. So and as part of that 60-day trial, of course, you get, obviously that's 2 months, so you'll get 2 of those chats to log in and ask any questions you like. We have a number of premium reports available right now to kind of help you get started with their top recommendations. And we have some, I think, pretty exciting issues coming up, including one on the opportunities and threats to energy and energy stocks from electric vehicles, as well as our classic year-end strategy issue where we kind of talk about what we see ahead and some of the names we like. Also, and this is for a very limited time as well, we are offering a very special bonus for those who choose the annual option for Energy and Income Advisor, and that's that you can receive a 1-year free subscription to Roger's premium newsletter called Conrad's Utility Investor. It's focused on the essential services sector. Roger, you're headed down here to Florida, right? In just a couple of days for the Edison Electric Institute conference in Orlando, I believe. Seems like a lot of conferences in Orlando these days. True. And you're going to be publishing or recording a detailed video. You're going to talk to a lot of management teams at all these big utilities around the country and elsewhere. and you're going to be presenting some of your top picks from that conference. I know last year and the year before, your picks coming out of that conference did tremendously. If you want to choose the annual option, we will give you a 1-year free subscription to Rogers, Conrad's Utility Investor, which is normally a $499 a year publication. And before you ask me, because I know some people on the webinar tonight, some attendees are already subscribers to Rogers, Conrad's Utility Investor. And if you are already a subscriber to Conrad's Utility Investor, we're not going to take this bonus away from you. If you sign up for the annual option for Energy and Income Advisor and call into the toll-free number I'm going to show you on the next slide, we will extend your current Conrad's Utility Investor subscriber by 1 year. So you'll still get benefit should you choose that annual option. We don't normally offer that, but that is a special bonus we're offering only to people who attended tonight's webinar. With that, I'm going to open it up to the question and answer session. If you are interested in taking advantage of the deals I showed you on the last slide, the special offer, that's the website you want to go to. Scroll down to the bottom of the screen, and there's a link which will automatically, if you use that link to subscribe, it'll automatically make sure you get all the bonuses I talked about. If you want to call in to our customer service department, our customer service manager, Sherry, will answer your call personally. We don't use a call center or anything like that. She's based in Southwest Virginia, and she'd love to talk to you between 9 a.m. and 5 p.m. Eastern time. Obviously, it's now 8 o'clock, so you'd have to call in tomorrow morning. If you call Sherry, though, please tell her the code WebinarVIP. You don't need to enter that on the website, but if you call Sherry, tell her that code to make sure you get all the bonuses I talked about. With that, that's also our email address if any questions come up later on that you want to ask. But right now, I'd love to turn it over to questions from our audience. If you'd like to ask a question, either enter it in the chat box or the Q&A box on your screen, and we will try to get to all the questions as they come in. To get us started, I'm just going to go ahead and ask a question we received by email from an attendee before tonight's webinar from an attendee named Kurt. And he asked you, Roger, he says, in Conrad's Utility Investor, you have Energy Transfer Partners rated to sell and have placed it on the endangered dividends list as well. Obviously, that's a name you've talked about a lot tonight. But his question is, how do you rate Energy Transfer Equity, ETE? You have indicated a resolution to Energy Transfer Partners could be merging into Energy Transfer Equity. Could you please speak to those two entities?
Okay, certainly. Energy Transfer Equity is really what this organization is run for. It's the general partner of Energy Transfer Partners. There are also a couple other assets that they had pieces of. But if you look at how this organization, what the priority is, it's going to always be for Energy Transfer Equity. And the reason is because the founder of the Energy Transfer Partners family, Kelsey Warren, that's his flagship. That's what he owns. Again, I think that's what when it comes down to what sort of distribution is going to be paid, where the debt load is going to wind up, they're going to take care of ETE before ETP. So, if I was going to own a piece of this business, that would be the name that I would look at. On the other hand, ETE's fortunes at the end of the day are connected to the Energy Transfer Partners assets. So while I don't believe that necessarily there are ways they could maintain their distribution, for example, while Energy Transfer Partners trimmed its distribution. They certainly proved that when they merged ETP in with SXL what we would call a stealth distribution.
Sunoco Logistics, right?
Yeah, Sunoco Logistics. Another name that we got, again, that we did quite well with earlier in the decade, that became considerably less so as time went on. But again, that's kind of it. I mean, I just think that any other. I just think the family really is just settled with too many legacy assets with too much debt. There are just other names out there that are much more exciting. But again, I think that Energy Transfer Equity is a better a better holding than Energy Transfer Partners, just because that's how they run it, and that's the your interests are going to be conjoined with the most influential guy on that in that organization.
All right, and the next question I have by email is about Williams Companies, symbol WMB. He says you have it as a hold in Conrad's Utility Investor. Is it a name that one should continue to hold, or is there a better replacement?
That's one I'm kind of been on the fence with to some extent. It's, I think they have taken some pretty painful medicine. They reduced the distribution first at Williams Companies, then they reduced it at the partnership, WPZ, Williams Partners, and raised it back partly at Williams Companies. I think they pretty much settled on a level, and I think the next move in the distribution is probably going to be up. The big thing that's happened there is kind of a realignment of assets to a more stable footing. So they've really changed their revenue mix, weighted it a lot more towards basic fee generating assets, gas pipelines in particular. They have a number of projects that they've been going through with that are just basically shipping gas to utilities, and those are probably the best counterparties you can have in the oil and gas business, because they're, of course, have regulated monopolies, whether they're electric companies that are powering gas-fired facilities, which are more and more being built throughout the country, particularly in the Southeast, and places where they're really replacing the old coal-fired facilities. And this is something, again, that Williams is taking advantage of and really plugged into. And what they've been getting rid of are assets that are more vulnerable to volume ups and downs, to energy prices, to frac spreads, and so forth, and prices of various liquids and byproducts of oil and gas in particular. One of the big move has been to put the Geismar facility on the block, which has been a very it's an olefins plant, and I won't get too in the weeds on that, but it's been one of view of operating efficiently and safely. So getting rid of that, I think, makes a huge difference. I think they may still have a few more adjustments to make. They did land with a whole bunch of debt, but I think it's one that I think we can hold on to. Do I like it as much as some of the other names like Enable? No, but I do think that it's a big name that makes a lot more sense to hold. I still also think that what we will see with Williams Partners eventually will be some kind of roll-up merger, and we've seen a couple of these before, and they've been pretty successful. A company called One Oak Partners rolled up into One Oak Incorporated, and that's been kind of a win-win, I think, for everybody, because it's cut the cost of capital in that outfit, and they've really been able to resume pretty robust distribution growth. So I think something like that, which would involve Williams Partners rolling up into Williams Companies, is very likely somewhere on the agenda. They attempted to do that a couple of years ago, and instead Energy Transfer Equity made a hostile bid to take out Williams Partners, and of course that bid ended very badly with Energy Transfer Equity trying to back out, and a huge flurry of lawsuits, et cetera, et cetera. But I think they may go back to that pie again and try to get that going. Williams Companies, that's pretty much their asset is what's in Williams Partners. So again, they're a lot further along in terms of, I think, the adjustment phase, and I think you can, and I just, as a general point, I mean, anything that I recommend as a whole, I mean, that's what I recommend. I think anything that I've recommended is sell. If I believe something ought to be sold, I'll recommend it as a sell. And in fact, I do have a record number of sells in Conrad's Utility Investor right now. And this is one of the few midstream names that I cover there. A lot more midstream. We cover all the MLPs in Energy and Income Advisor. So in any case, that's my view on Williams. So it's a legit hold.
Okay, we have one more question coming in via email before the conference, and that was the reader's asking about, she saw this company called York Water in the Barrens. Do you have any comments about that name? I know that's not an MLP, but maybe it's a name you cover in Conrad's Utility Investor.
Yes, I did cover it there, and it's last in the alphabet, so it's at the bottom of the table. Small water company. A really well-run water company based in Pennsylvania. The only problem with it is an extremely high valuation, and a lot of money has gone into these water utilities. He's actually not a water industry executive anymore, Nick DeBenedictis, but he used to run Aqua America, and once he when in one of our discussions referred to water utilities as basically like collector cars, that there's only just a very small number of them, and that therefore they're going to earn a premium valuation on that basis, if nothing else. And of course, water utilities is a very steady business because water is very much an essential commodity, and companies are now investing in doing things like replacing mains and pipes and so forth that in some parts of the country are 100 years plus. And, by doing so, they get to add that to rate base, which is what dividends are paid out of. And they also can become more efficient, waste less water, so they bring their costs down as well. They can keep a lid on rates even as they're raising rate base and raising earnings. So that's a very favorable dynamic. But on the other hand, you get a company like York that yields right around, I think, 2% and is growing its dividend, not a lot above that. So not a really good value proposition. I think a lot of people are looking for more takeovers in this space, but it's actually a lot easier for, say, a company, a larger company in the space like Aqua America, which is also headquartered in Pennsylvania. It's just a lot easier for them to do deals with municipalities or with smaller investor-owned companies that are small districts that are struggling to meet Clean Water Act regulations and therefore are going to be cheaper and easier pickups, and then they can just basically make some improvements, tie them into their existing systems, and that's how they can definitely make a lot more money. I mean, acquiring a company like York for a company like Aqua would probably be dilutive, at least over a small period of time, even though Aqua is a much larger outfit. So I think, just to keep a long story from getting longer, that's not a name I'm very interested in right now. I think if you want to get a water utility, look for Aqua and look for it at a little bit lower price. And we do have buy up to targets for all the collector car water utilities in the U.S., as well as some names that are actually maybe a little bit more attractive that are outside the U.S. in Conrad's Utility Investor.
Okay, well, the first question we got actually live on tonight's webinar, and this is a stock that you and I have been talking about an awful lot last week or two. And the reader asks, is there any hope for Newstar, symbol NS? Well,
I think there is hope for Newstar. We really like we always enjoy speaking with the CEO runs that company, Brad Barron. Always had some interesting things to say about the overall industry. Always has, I think, a pretty good plan. His main problem coming in has been just basically legacy, and which of previous management. And this is a company that owned asphalt, this distribution, which they bought from the Venezuelans, and was basically catastrophic to their earnings. They bought a refinery at one time in the San Antonio area. A decent asset, but well outside of anything that they really had any kind of expertise running. So they poured a lot of money into it and then wound up basically selling it for a little bit more than they paid for it. And the cost of all these types of acquisitions and the rundown of the asphalt business, and also getting involved in some of the more commodity price sensitive part of the business, meant that despite the fact that this thing grew out of this, arguably the safest of all midstream assets, which are basically refinery logistics. So basically pipelines that come out of refineries, and their original parent was Valero, the large refiner. So they had tremendous asset base that they tremendously diluted. They of course got rid of a lot of those assets, and that was a feat in and of itself to be able to maintain their distribution while they were clearing out of some of these assets. But they haven't gotten out of really everything. They have a number of assets that are somewhat troubled, one of which being a lot of pipeline and related assets in serving the Eagle Ford Shale area in South Texas, which, as I mentioned in that early slide, has continues to see a drop off in activity. So one thing that we were, that became pretty clear when we were at the MLP conference last year, and listening to management at the breakout session, asking a few questions, is that it seems pretty clear to us that they're facing a revenue cliff as a number of contracts come off in that Eagle Ford Shale area over the next year. So by the middle of next year, a lot of these contracts are going to come off. And the implication that we got was that would be the time when they'd be trimming the distribution. Well, you might have noticed this thing has really come down just really like a stone. One reason is that now we're seeing some threats to some of the other assets they have, particularly terminals. They had a couple shut down, a couple of very some damages from some of the storms that we saw, particularly some of the assets in the Caribbean they have, but also on the Texas coast. And we think that our thought's been that this will interfere with revenues. But now we just saw some news today. They had taken the Venezuelan business away from Buckeye Partners, and basically taking it at one of their terminals in the Caribbean. And now it appears that maybe that wasn't such a good thing, because the Venezuelans appear to be defaulting on their bill. They're not paying their bills, and they appear to be defaulting on contracts. And that's going to come right out of cash flow. So at a time when this company is already seeing an existential threat to cash flow, in like 8 or 9 months from now, or at least by the middle of next year, from that drop off in the Eagle Ford Shale, we're seeing cash flow in some of these assets I think they were counting on to tide them over drop off. And then they're also trying to get involved. They just made this major purchase in the Permian Basin. So we think that's a good purchase, and we think these are assets that are going to match up well with some of the other things that they have. But it did require they did have to spend money to acquire the asset, and they have spent this money at the same time that cash flow is under fire in some of their storage assets, and we're seeing the threat of contracts coming off. So I think what they should do, and again, I'm sure they won't listen to me, but and probably shouldn't. But I think this is a pretty classic example of a company that needs to quote unquote right size its distribution. So I think they're going to have to. I think they're going to reduce their distribution probably sooner rather than later. They did just affirm it this month. So they just declared the distribution at the same rate that they paid for the last several years. But I think what they really need to do here is just rip the Band-Aid off, start shepherding some of these cash flows, start using some of that surplus cash flow to really get after debt levels and bring those into line, and then cut some of these assets loose and that have been underperformers, or at least right size the cash flows coming out of them, and start cutting costs, and then focus on this Permian Basin assets, which I think are in good shape. So 2 or 3 years down there, I think their adjustment phase is going to continue for the next couple of years. Again, we'll be meeting with them at the MLP conference, and that's a report that we always enjoy doing for Energy and Income Advisor readers once a year, and that will be, I guess, early June. and again, we'll be talking to them then, but there is a lot of water that's coming under the dam until then, and things are just the business momentum at this point anyway is definitely moving against them. So, if you still own this name, if I look at it and right now, I would say that you are pricing in at least some sort of distribution cut. On the other hand, those are always dangerous words to say, quote unquote, pricing in, because as we know, when a company does make a move like that, there's always often a stampede out. So this is a name I'd be very, very careful of. And again, we think that there will be a distribution cut, and that's what they need. We think that's what they need to do, and that could create more downside, even though we have come all the way down here into the 30s on this name. I think you could easily, with a distribution cut, see a mid-20s or even low 20s share price, depending on a couple things. One, the state of the general market. Obviously, if you make these moves when everything's going down, they tend to be quite magnified, which would argue for doing something sooner rather than later. But what's going on with the general MLP space, and if we do see somebody else cut a distribution here that creates more running for the exits, it just gets harder for Newstar to fund anything with equity capital. Now, they might roll this thing up into the general partner. That's the way that, again, companies have been able to save money by eliminating the IDR structure and so forth. Their IDRs are actually, which are incentive distribution rights for general partners, they're actually maxed out, and they're actually fairly low for being maxed out. But again, this is a name that I think we want to be very careful of, and while I don't think that they have the bankruptcy potential bankruptcy characteristics that a feral gas has, I do think they could definitely go a lot lower before they make the turn and start heading higher.
Yeah, in fact, if that company were to cut distributions, that actually might be the opportunity we're looking for to get into a name like that.
Yeah, absolutely. And like I say, I think the management team they have in place right now is pretty knowledgeable and certainly is very highly respected. They just still have a hand of legacy assets that are bringing them down. And again, I don't think that we've seen the bottom for those Eagleford assets. They've, I think that decision to getting that business from Venezuela is coming back to haunt them as well.
Okay, well, that's an important name, a name we get asked about a lot. But the next question is actually not about an MLP. It's about Jones Energy. And basically, what's our view on Jones? There was announced activism by two separate companies. The stock rallied, and now it's going lower. Should it take the loss, or it's not a huge position? Should I be willing to wait it out? This is a name that we've held in our trading service. We have a shorter-term trading service called Pig versus Bear, where we seek to participate in shorter-term moves in energy markets and energy stocks. It's a very aggressive name. It's not a name that we would recommend holding a large position in. It's trading under $2 a share, down in the low ones. The company owns an asset in what's called the merge play. So Roger was talking earlier about the Scoop and Stack fields of Oklahoma. They're both in central Oklahoma, but the Stack plays to the north, the Scoop plays to the south, and in between the two, rather uncreatively, they've called the merge between the Stack and the Scoop. There basically are two productive intervals there. There's a Merrimack formation, which is a little bit shallower, and then you have the Woodford formation, which is a little bit deeper. And Jones has been drilling wells there and has had some great well results, particularly out of the Merrimack section of the play. Jones' problem is debt. They've got just too much debt. And it's difficult for them to fund the capital spending they need to fund to prove out their reserves. So what the two activist investors are looking for them to do is either sell themselves outright, sell off assets, or partner with a bigger energy company to fund their drilling. I think there are a couple upside catalysts coming forward that makes it worthwhile holding on to this name from a speculative standpoint. One of them is they have earnings coming up. I believe right at the beginning of November, the 1st or 2nd of November. I don't think they've confirmed yet, but should be the first part of November, first couple days of November. And I think they're going to announce as part of that a bunch of new well results, which could be an upside catalyst. I actually would not be surprised at all to see them announce some sort of a joint venture or a drill co-arrangement, later on this year, very early in the new year, which could cause the stock to go up a lot. When I say that, I mean, you could easily see this stock shoot up to $4 or $5 a share if they announce a deal with another producer to help fund their capital spending. Jones is not really a long-term holding for us. They don't pay a dividend. This is more a speculation, and we do think that it's a name worth holding on to. Obviously, very volatile, but more likely to have some good news over the next few months. Rather than bad news, it's going to send it back down under $1. That's kind of how I guess I answered that one.
Yeah,
it's the name I
Not
covered.
as well as I couldn't have answered it that well. So I think that's
Well,
yeah.
the next question is actually about oil prices, which is many of the pundits believe oil prices are headed up. One estimate was $70 a barrel by early 2018. You seem to disagree. Could you please explain? Well, I think we've actually been pretty consistent in our outlook for oil. As Roger alluded to, back in 2014, we forecast that oil would eventually drop down to $25 to $30 a barrel. It got down to 26. We felt late last year when OPEC had their meeting, we felt that that it was kind of bogus, and that oil production growth out of the U.S. would ultimately push oil back down to the high 30s or low 40s. I think we got down to a low of 42. Since that happened in June, we've actually turned increasingly bullish on oil. We're actually taking kind of the opposite position that we've been taking over the last few years. I could see, our view is that WTI could get into the 60s by next summer because you have slowing U.S. oil production growth, strong demand growth, and I think a big risk you have coming up, I don't know if it's going to be an issue next year so much as the year after, is just the lack of investment in oil fields exploration and development, especially outside North America over the last few years. I think that's going to lead to kind of a black hole of supply by 2019, 2020. $70 by early next year, seems very aggressive to me. I mean, maybe Brent crude oil is up around 57 already. I could certainly see that getting up into the 60s by, say, the first quarter of next year. I think the problem, if you saw WTI, which is the U.S. benchmark, at 70, is that you're going to see so much drilling in U.S. shale fields because they can make so much money at that price that, I mean, the supply growth would pretty much overwhelm the market. I think that, $60, $65 a barrel by next year sometime for West Texas Intermediate is a strong possibility. And the good news is at those prices, a lot of companies can make money, and I think a lot of the MLPs are going to see a lot of volume growth, even out of some of these more marginal basins, perhaps. We're bullish on oil, I guess, but not quite that bullish. Not quite 70 by early 2018.
I guess like for MLPs, I mean, the real question is where they're it's still like where they're operating. I mean, because you're still talking about market share, kind of a market share based profit scheme than just priced. I mean, I think 70 obviously would be really good news for some of those places where people have been, companies have been struggling, and midstream companies have been struggling, and you could see some sort of reprieve there. But I guess, but I do think still, most of the benefit will go towards the places where people can make more money and keep the costs lower. I mean, it's still, I wouldn't, and I guess the bottom line, I just wouldn't count on it to bail out some of these weaker MLP names.
Yeah, it just seems kind of like a big speculation to think it's going to get that high. I mean, plus, if you buy the names that you're talking about, that are more stable and have assets in places like the Permian. I mean, at $55 crude, there are a lot of wells in the Permian that are probably producing 150% return on investment or higher.
Yeah.
So you're going to see more drilling activity there as well. They're going to benefit. Why not just bet on something that can make money even with oil at 45 or 50 and continue to grow its distribution rather than doing the Hail Mary pass and trying to buy an MLP that might be okay if oil does get up to 70.
Or even sticking with a name that you got really comfortable with and just saying, well, higher oil prices are going to keep keep NuStar from cutting its distribution next year. I mean, $100 oil would, I think, help everybody. But again, I think there are probably other things you could buy, and particularly producers that would make you a lot more money than than NuStar, which best case here is they just maintain the payout, or Energy Transfer Partners. Really, that's what you're talking about here. And I think a lot of the names we've been talking about, MLPs, but also producers that you've been talking about in EIA pretty consistently the last few months. I mean, those are really super leveraged to that kind of move in oil. So I mean, everybody's got to make choices with their dollars. Nobody has theoretically the unlimited number of dollars, but to really take advantage of what we think we're going to see in the energy market, you really want to be selective. And we all that's another good reason why you want to look at individual companies and not some of these big ETFs, because that may or may not own the right kind of names. It's a stock pickers market. It has been the last few years, and again, that's if you're going to make money in energy, that's what you have to do.
Yeah, okay. Well, the next question is a simple question, which is MMP and EPD, keep or sell. So that's Magellan Midstream Partners and Enterprise Products Partners. What's your thought there, Roger? Keep or sell, those two names?
Well, I think you keep both of them. I mean, these are best-in-class names that have been best-in-class names for a while. They didn't overpromise during the boom period. I think I mentioned that when I was in the earlier remarks. And as a result, they're not over-leveraged. Their assets are in good places. Enterprise is really an interesting asset mix because they have basically positioned themselves in the Gulf as a major facilitator of exports, not just oil, but also various natural gas liquids. And this is a business that is only going to become more prolific going forward. So they're in really good shape. Some of their major customers are it's a who's who of the energy business, U.S. energy business. So these companies have good balance sheets, good projects, and the few names in this that names that we really liked back in 2009. These are among the few that we still really like today. So they're both trading below buy targets we have, but I think the long and short of it is you want to hold those names.
Okay, and the next question actually asks again about EPD, which you just kind of covered, and also asks about Enable, which obviously you discussed at length as having liked on the conference on the webinar earlier. Two other names he asks about are BPL, which is Buckeye Partners, and ENLK, which is NLink. And he says he owns more of the first two, which are EPD and BPL. Mm-hmm. Any others? Any others that to balance out that portfolio? I mean, I guess, what do you think about BPL first of all?
Well, I think BPL is a name that is pretty interesting right now. I mean, you're down here at really multi-year support, and in terms of the unit price, and which has been holding fairly consistently, kind of bouncing off of it recently. I think it's an example of a name that's gotten caught up with a lot of worse names, and just simply because it's got a fairly high yield. I think that third quarter very likely will be soft just because of the impact of some of the storms that we've had on various assets. But this is a company that, well, partly for that, also partly because of conditions in the global storage business, which they have just made a major acquisition in. But this is a company that, again, that didn't really overextend during the bull period. And, I think we will see another distribution increase as they announce their third quarter results. And, this is, I think, in any case, one that looks like, if you look at the price history of it, it's been quite volatile for a company that really isn't that volatile. For a company that's 98% of cash flow coming from basic fee-based businesses where the profit margin doesn't really move very much, the shares move quite a bit. So this is a name to watch. It's one you're going to want to probably manage here, and we do have it in a couple of publications, but I think it's definitely for the yield and considering the quality of the asset base, the investment grade balance sheet, and so forth, the cost of capital being very moderate. It's you don't see those strengths reflected in the share price.
Okay, and the next question is, do you like refiners like CVRR? CVRR is one of those variable distribution MLPs. The other one I think is Elan, ALDW. Refiners have not been our favorite segment to buy, partly because I think a lot of the recent rally in the refiners is basically related to the hurricane activity. We saw refining margins really spike. If you remember, to understand how the refining business works, right? Refiners are very unique in the energy space because they don't really benefit from rising oil prices. Almost every other energy stock, in one way or another, benefits from rising commodity prices. Refiners don't. Refiners are essentially manufacturers. And like any manufacturer, they have a raw material and they have a product. Refiners' raw material is oil. And their product is gasoline and diesel primarily. So if the price of oil goes up, it just means that their costs are going up. Unless the price of gasoline goes up more than the price of oil, and then their profit margins expand. And what we saw after Hurricane Harvey in particular is a bunch of refining capacity get knocked offline in the U.S. Gulf of Mexico. Gasoline prices shot up and distillate prices shot up. Distillates being diesel and heating oil. So refining margins expanded, but historically those have then gone on to contract after the effects of the hurricane fade, and we're already beginning to see that. Gasoline inventories jumped a lot last week, and if that continues, I think you're going to see margins come down, and it's going to put pressure on names like CVRR. On the other hand, an area that we do like somewhat in the MLPs is one that Roger alluded to earlier, which is the companies that own pipelines that connect to refineries. That can be a very stable business that because you're owning a pipeline that's basically a monopoly for that refiner, right? The refiner has to pretty much use that pipeline to transport oil to it or gasoline and diesel fuel away from it. Tends to be very long-term contracts at fixed rates. So those are names that just don't tend to have a lot of commodity price risk. And we've recommended a number of those in the newsletter at times, especially some of the smaller, kind of more overlooked names in that group. Delic has one, for example. So anyway, that's what I would say on that. I don't know, Roger, if you have anything.
Yeah, I think that's 100% on it. I mean, another thing that just occurred to me while you were talking, I mean, it's very hard to build a refinery in North America for a lot of reasons. No one wants to site it's very hard to site a refinery. It's very much a NIMBY, not in my backyard situation. So that definitely plays in the hands of this type of company. And again, this is an advantage of going company by company rather than trying to buy something in an ETF, because obviously a smaller name that's involved in that business is probably not going to show up in any meaningful way in an index. But yeah, I mean, refiners, another point about the refiners, a lot of people were thinking that they were going to have an easier road regarding regulations on various fuel mixes, particularly like ethanol and so forth. But now we've seen, the farm states have won, and we're not going to see any rollback of, ethanol and so forth. And so, again, that's not very good for refiners. It's kind of amazing to look at some of these refiner stocks and see them, kind of levitate, even though, the underlying business has been getting hurt. But, eventually that does catch up to the share prices.
Okay, the next question on the list here is why does Enterprise Products Partners stock continue to go down when they have so many good things going for the company and they are growing? I don't know. You want to take a stab at that one?
Yeah, I mean, good question. I think one thing that we always go back to is that it is a big part of these of the Alerian MLP index. So
what is it? 20%? It's like 20%.
Yeah, it's like 20%. Right. So when these people come in and start hitting MLPs, they say, well, I've got to get rid of the MLPs, and again, things that have nothing to do with Enterprise, like Genesis. I mean, Genesis actually operates in the same a lot of the same general areas as Enterprise, but it's really it comes nowhere close to matching the scale or profitability. But sometimes it's possible that has something to do with it as well. They are about 20% of the Alerian index. One thing that they've done that may be impacting them very short term, because they've only announced it like in the last couple of weeks, and that is that they reduced their rate of distribution growth. They're not reducing their distribution; they're just reducing the rate that they've been growing it. So they had only been growing at about 5% a year. Now they're growing at about half that. But the management's rationale for that is that basically that they can use the cash flow to better finance what they're doing in terms of capital spending and expansion. So we kind of like that rationale. I think it's when you're in an environment where equity prices are low in your sector, the more you can finance more growth you can finance without issuing new equity is bullish. And I think that's the way a lot of the market players are viewing it. Again, we might have seen some reaction, a point or so reaction to the fact that the distribution is growing at a slower rate, but this is going to really position it well in terms of capital, cash flow, and so forth, and the ability to finance the growth projects that it has. So it's just a step in a conservative direction. We're very comfortable holding this name. It is possible that a company like Enterprise would consider converting to a corporation like Kinder Morgan has. One thing that may hold it back, though, is the fact that it is very heavily owned by the Duncan family. Of course, Dan Duncan, the late legendary founder of Enterprise Products Partners. But they own a very large portion of Enterprise. I think pretty cless to 30% of Enterprise. So they're a huge shareholder, and their interests are aligned with ours as unit holders, as common unit holders as well. So that's a pretty good argument why, if you do get a conversion to corporation, it will be done under terms that don't burn long-term shareholders as many Kinder Morgan Energy Partners unit holders. And even that deal, the offer was at quite a substantial premium to what the share price had been. So that did cover potential taxes for most people. But I think that, when Kinder shareholders really got hurt, it was then later in the cycle when they had to eventually cut the distribution and so forth. But I don't foresee that same kind of thing happening with Enterprise Products Partners. For one thing, we are a lot further along in the cycle. But bottom line is, you have a very, very cheap a cheap stock, big yield, and a the strongest balance sheet in the group. So no problems continuing to recommend that name, despite the share price action, which hasn't been great, but I think eventually we will see a return to upward momentum for that name.
Yeah, I agree. That's actually, I wouldn't say this about very many stocks, but that's been one of those one decision stocks for so long, in the sense that, you just kind of buy it and hold it, collect the distributions. And, one strategy though that we have used, and I remember this back a couple of times. One was back during the Great Recession and financial crisis. And, it was just to kind of have a limit order out there. Roger and I call these dream buy prices, where you have sort of a limit order to buy a stock like Enterprise at a price that, is so low that if it ever got there, it would be just an amazing bargain. And, that strategy that's a name that has worked well for. When you see everybody panic in selling EPD like they are now, eventually that stock's going to get down to that sort of dream buy price level, which I still think we have one set in the newsletter. That they might actually be a great buy, because you're gonna get it at so low a price that you're getting a nice yield for some of the best assets in the business.
Yeah, absolutely.
Yeah, I guess the next question here is your thoughts on Buckeye. I know you've kind of answered that I guess already, but generally pretty positive on that one.
Yeah, I'm sorry. What?
Buckeye.
Yeah, Buckeye. Yeah, like I said before, for a number of reasons, I do think good assets and so on. I think probably being thrown in with a group of weaker companies, but guilt by association that it doesn't really deserve.
Yeah, and the next question is buy, sell, or hold on Genesis, in your opinion. I know this is one you talked about.
Yeah, I still think I still think it's a name to generally steer clear of. Obviously, it's come down a long way, and right sizing the distribution. It looks like they should be able to hold it, but that's not really the criteria you should use for continuing to hold a company. I just think their assets are quite a hodgepodge, and while their cash flow might be back in line with their distribution, I think there's a lot more attractive names out there.
Okay, the next thing isn't really a question, but it's a comment. It's Roger and Elliott, your knowledge and advice are of no comparison and very much appreciated. I'm a current subscriber of CUI and Capitalist Times, but I want to also subscribe to EIA, but the energy market's been so volatile. Thank you guys for all that you do. Promise that's not like one of our team members kind of acting as a shill here. Thank you very much. It's always great to hear comments like that. We certainly enjoy covering all these markets and have for a long time. So thanks for that. The next question is, okay, now this is one that you and I have talked about a lot, Roger, including a lot at the MLPA Association conference every year in Orlando, and that's Martin Midstream, symbol MMLP. I think that you and I have probably been to every one of their presentations for the last several years, and I think we both always come away with the same conclusion, right?
Yeah, I mean, basically the conclusion is just it's such a diversified or hodgepodge,
right?
Using that word, it's the only thing you can say, the presentation is basically, hey, we got a big yield, and we have, look at all this cool stuff we have, so again, I just don't think that these are the kinds of MLPs that people want to get involved with. These super diversified MLPs that are wind up being, a jack of all trades and master of none. So they're all over the place, but they don't have scale in any of them, and it's a competitive business. I mean, we tend to look at energy companies and say, well, what's the price of oil? What's the price of gas? But when you're in an environment, which we talked about throughout this call, of lower for longer is one way of looking at it. Energy prices where you're not going to get to 100 anytime soon. it really does come down to who can compete, who can do things more cheaply. And a lot of that has to do with scale. When you're talking about a big capital intensive business, like a lot of these things. So again, a lot of people are just, they look down one column of any kind of rating system, and they look for the yield. And they want to buy the big yield, and they want to know if the big yield is going to continue to be paid. And that's fine. That's a particular strategy, but it's not going to really necessarily over a long period of time create the kind of returns that we want, and the kind of returns you can get when you invest in energy at this stage in the cycle. Which I guess circling back, I mean, that's what we're really talking about here is. What do you want to invest in? Here we are. We've been through this massive bear market in energy. We're still seeing a lot of adjusting going on, and companies cutting distributions. Even some of these names that we thought were going to make it through to the next cycle that did make it through. If you look back at 2007, 2008, 2009, particularly when oil price went from 150 down under $30 for a short time. By early 2009, that did make it through that period, but because of all getting really aggressive with their expansion, in part taking on too much debt, now they're having to adjust. So those are, again, that's the question is, do you want to own that type of name where the best you can really hope for is kind of standing pat and holding a dividend maybe, or do you want to own changing these new names? Do you want to own, or even some of the older names that have made the adjustment that can, benefit from what we're talking about here, a return to, oil prices, $10, $15 above where we are now, gas prices, things really firming up over the next few years. And history shows again and again that it's the companies that have positioned themselves that have come through the last cut down with a minimal amount of baggage that are going to benefit. And a rising tide does raise all boats, but if the tide, only if the tide rises enough, well, is it going to raise, some of these underperforming? It's really, just you really want to be selective, and I think that's where we've been focused in Energy and Income Advisor, and that's I think critical for anybody that's going to make money in energy.
Yeah, absolutely. The next question here is, are AT&T, Verizon, or NextEra Energy Partners, NEP, are any of those three buys at this time? I know you cover all those.
Well, yeah. So, in Conrad Utility Investor, we cover all those. We also cover, a couple of those names. There's a little bit of overlap with Capitalist Times as well. I do think the big telephone companies are a good value proposition at this point. AT&T and Verizon. The big thing happening in telecom is what's and what to expect over the next 2 or 3 years is the advent of 5G wireless, and we have done a lot of research on that. We also have another product, Deep Dive Investing, where it's a video product, and so we've done some very extensive deep dives into the Internet of Things, for example, which is machine-to-machine emerging machine-to-machine communications. And 5G is a facilitator of that. It's also a facilitator of very, very rapid data, and which has a huge number of applications, both in enterprises as well as in industries, individual industries, as well as on the consumer side, where 5G has been described as a technology, a communication system that will allow someone to download a full movie within a couple of seconds, and the equivalent of that kind. So it's a big deal, and these companies, the big companies, have the ability to invest in it, build the infrastructure, build the kind of capabilities they need as just part of their ordinary capital spending. If you look at any of the rivals these companies have, and this actually does include T-Mobile. I know a lot of people, it's a favorite of a lot of people, but these companies, when they spend, their capital spending is a fraction of what AT&T and Verizon can do. And by a fraction, I mean, in many cases, a fifth, a quarter to a fifth. And when they spend that kind of money, it has to come from somewhere. They're not generating it from their operating cash flow. They're borrowing it or they're issuing shares. And that's an unsustainable pattern when you're competing against larger companies that are not only outspending you by 4 or 5 to 1 in an industry that requires intense capital spending, but they're doing it at the same time they're paying dividends and they're controlling their debt, and so on and so forth. So I do think these names are a great value proposition. They do pay some fairly substantial dividends, which they increase, and that more or less tying us over until we get the next big boom. And there's a tremendous data volumes alone. If you look at some of the projections there, we're looking at data traffic on these networks 5 to 10 times what it is now. So a lot of money to be made in those, but it's going to be made in the best in class with the best networks. I think a lot of the companies that I cover in the communications business and Conrad's utility investor very likely aren't going to be around another 5 years. I just recently looked back at my coverage universe of telecom. So I've been looking at this space for a pretty long time. I look back at what I was covering back in the late 1990s, almost 70 different companies in that universe, and now we're down to 20 of any kind of substance. And it wasn't pretty. Some of those names did get merged in, Baby Bells and so forth, but some of them just vanished off the planet because they just weren't able to keep up at the end of the day. So I do like those names a lot, and again, it's long-term value proposition. NextEra Energy Partners, this is, despite the name confusion there, the only entity that benefits from a partnership structure is the parent, which is NextEra Energy. As far as people who own, individual investors who own it, the symbol is NEP. This is a yieldco, so it basically does thrive off of drop downs from the parent. In this case, mostly wind and solar assets. NextEra Energy is the parent company of Florida Power and Light, but it's also the largest producer in the U.S. of wind and solar, contracted wind and solar energy. So they operate facilities under 20, 30-year contracts with primarily utilities around the country. Again, very good counterparty. So they drop down these assets to NextEra Energy Partners, and it's the best in class name in the yieldco space. It's been very, very successful for us in Energy and Income Advisor, as well as Conrad's utility investor. Very successful in investment. I just think right now it's a little bit expensive. I'd like to see it come back a little bit. Great name, but it's a pretty classic example of a name that if you had, honestly, if you had followed our advice and bought it back when it was back in the 20s, you'd be sitting very pretty right now. But here in the low to mid 40s, while I do think it will get eventually $50, $60, I think it's going to have to digest those gains before it'll get there. So that's a name that I think I would rate as a hold on a valuation basis.
Okay, the next question is, do you see the Northern Oil and Gas business, that's NOG symbol, business model of controlling the lease acreage and renting it to drillers in North Dakota and Montana ever regaining profitability? Thanks in advance. The Bakken Shale, I can start off with that, but the Bakken Shale is, one of the higher costs. There are some parts of the Bakken Shale, I should say, which are actually quite attractive and have quite decent returns at $50 oil and $45 to $50 oil. There are a few sort of sweet spots in that play that are profitable at that kind of price, especially if a producer has the ability to drill these super long lateral wells, long horizontal segment wells. But North Dakota and Montana, which is the Bakken Shale, doesn't really just have quite the economics of, say, Permian Basin or a scoop stack, which I think you can probably see on that first slide that Roger put up, where you see the production growth and the Permian just keeps going up, and the Bakken and all the other plays, the Eagle Ford particularly, have kind of come off. I would say that we talked to and saw a number of presenters in that business, the royalty business basically, presenting at the Permian Basin Conference when we were out there, I guess last April, so earlier this year, 6 months ago or so. And I would say that it is an interesting business, and one name that we have looked at, we're not recommending right now, but we have looked at in some of our in reports in the past is the symbol is BSM. It's Blackstone Minerals, and what I really like about them is they buy up, instead of just focusing on one area like North Dakota and Montana, they buy up lease acreage all over the country. So yeah, they have some lease acreage in the Bakken. Yeah, they have some lease acreage in the Eagle Ford, but they also have Scoop Stack and Permian and Marcellus Shale on the gas side. And it kind of takes a little bit of a knack, I think, that business, because you got to go out and buy up these mineral rights from people that are kind of in areas that are going to be drilled in the future by the big producers. So they have to be able to kind of figure out, like, where, here's where this producer's drilling today, and they're moving down this trend, and they're going to end up here. And kind of buy the leases and the royalty rights ahead of that. So yeah, I mean, I think it can be an interesting business. I mean, it's not something that we've been real bullish on, mainly because it's not a business that makes a lot of money when oil prices aren't above a certain level. But I think a name like Blackstone could be something that we would look at as oil prices sort of stabilize in the 50s and higher. Because I just think that their diversification among a number of different shale plays makes more sense.
Yeah, and I would add to that I know we get a number of questions in our monthly Energy and Income Advisor chats, which again we field them all, and we haven't talked a lot about these names for a while. We were bullish on them, somewhat bullish on them back when oil was up at $100, but these are names that we've been out of really since you made that forecast about oil, and these are like particularly the Sandridge royalty trust and the Chesapeakes and so forth. And the differentiator from that, another differentiator between that and and the name we just mentioned, is that these things were all set up when oil was like at $100. When gas was like $5 or $6 a million BTU, and that's really the bottom line. They're just not. They just weren't created for the current pricing environment that we have. I mean, these are kind of based out of wells that the economics are now quite questionable, and it's not really like when you buy an operating company, these types of things, because you basically are dependent on the economics of just several wells. I would differentiate also some of the names that we do cover in Canada and elsewhere, but particularly Canada. This is a model that's caught on, and we do cover a number of these in that area, and they basically own the lands, and then others come on and and drill on those lands. And again, it comes down to the same kind of thing. I mean, are the cash flows that the valuation of this royalty entity, are they based on drilling on lands at $100 oil? Are they based on are all the economics, everything based on, is it all based on $50 oil, or is it based on $40? The lower that goes, the better those royalty trusts are going to perform. But those old names, and again, it goes, we do get these questions all the time, these old names that people got comfortable with, and they want to know, is there any value there? Maybe there's not, and in any case, even if there is, there's better stuff out there that's more in tune with the economics of oil and gas in North America now. So that's where you want to focus, again, as we're coming into this coming out of this real bearish stage in the energy market, coming into a more bullish one, you don't go back to the stuff that was super profitable at $100, $150 oil, or even marginally profitable. I mean, you go with the stuff, you take a look with fresh eyes, and you buy the stuff that's going to do the best at this price range level. And again, that's where we are. That's where we are in Energy and Income Advisor, and we see a lot of opportunity, but also a lot of danger.
Yeah, and the next question is EQT, buy, hold, or sell. And I would just say with that, EQT is a producer which focuses on the Marcellus Shale, and which is a gas field. It's one of the lower production costs. It is the lowest production cost gas field in the U.S. Right now we're not really bullish on gas. I think gas rallied a little bit, coming out of summer on expectations that we might have a cold winter. But the supply-demand balance in the gas market is not particularly positive. However, EQT does have an MLP, which owns their midstream assets, and I think I can say that's a name that we like. I don't know, Roger. Do you have any thoughts on?
Yeah, that's right, and it's actually a pretty interesting story. As there's a number of private capital entities sniffing around. We talked about Jones earlier on, but in this particular situation, there are some activist shareholders, I guess we should call them, that could really drive value. But that's also a very interesting name, and very good economics. When in the Marcellus, and in Utica and so forth, that particularly when we start seeing some of these big pipelines being completed and bring some of that gas to utilities in the Southeast and Mid-Atlantic states, where we're retiring a lot of those old geriatric coal plants that are still running, and utilities are replacing with gas. Again, it's kind of a match made in heaven. In fact, a lot of the utilities are investing in these pipelines too. So they're getting built, and they're feeding their need, and it's definitely a good reason to look at these lower cost names in the Marcellus and Utica, which we do have several in our model portfolios, and we're becoming bullish on. But of course, this is a volume thing. It's not a call for gas to go to $5 or $6 on any kind of permanent basis. I just really, I know prices move around, and some people, try to invest in gas based on forecasts for the weather. But I mean, ultimately, that's not really a prudent way for long-term people to approach. I don't think.
No, right. I think that's very, very true. The next question I see here is actually a tax question, which is, if Congress passes a tax reduction for corporations in the U.S., is there also a tax reduction for MLPs? And will Congress pass a tax reduction for the MLPs? Well, MLPs are actually, they don't pay corporate tax.
Yeah.
So they wouldn't benefit directly from a cut in the corporate tax rate. If there's an individual tax cut, though, as a result of an overall tax plan, then that would benefit you as an MLP holder, because a lot of the income that's passed through to you as a unit holder is not taxed until you sell the MLP. But then it would be taxed at your income tax rate. So if there's a cut in your income tax rate, because they consolidate the number of brackets and lower the top bracket, then that would benefit you in terms of investing in MLPs or earning income in any other way. There has been some talk of a change in the taxation on pass-through entities. I don't know you have to look at the fine print to see whether that would help you investing in an MLP. I also know that this is something that's been talked about a lot. There has been some talk about some MLPs wanting to convert into corporations, maybe if there was a lower tax rate? I don't know, Roger. Is that something you've looked at more closely?
Yeah, it's always hanging back there. I mean, if they did cut their, if they did, if you did cut the corporate tax rate, would it be beneficial, say, for a company like Enterprise to convert to a corporation? It costs them a fair amount of money to, print out, send those K-1s to. I know everybody hates to get them, but they hate to I'm sure they hate to put them together. And perhaps that would be something they would consider. I mean, they do have, like I say, EPCO, which is the Duncan family's holding. That's how they hold their shares. They're a huge shareholder or unit holder of Enterprise, and I think, again, their interests are more or less conjoined with ours. To really make these roll-up deals work too, you have to get the limited partners to go along, and that will generally require a pretty good deal for them. So, if to the extent you do see these, and we have seen plenty of these, right? These roll-ups like the One Oak and so forth that I mentioned. And I think Williams could go the same route. Again, they just have to make a pretty good offering, and it's got to benefit to do so. It's got to benefit the unit holder. So that's possible. I mean, a lot of people say, well, what about if they are they targeting MLPs? I don't know of any tax targeted at MLPs. I know it's always the beneficiaries of the carried interest provision, which are
hedge MLPs, funds and that kind of thing.
And a lot of these outfits that operate outside of energy, you always hear talk about perhaps those becoming taxed in some way, but I haven't heard about anything like that this time around. I mean, it's definitely something this is, I think, really a work in progress, this tax reform, and I think there's a lot of distance to go before you get to the finish line. So this is going to be something we're going to be talking about a lot going forward. But I think, the best defense against anything is just to own well-managed companies. And I say that with the Canadian Income Trust example in mind. There was a sell-off on the first couple of weeks after the Halloween massacre when they announced that very popular income trusts were going to be basically pronounced a death sentence in Canada on those, that they had to convert to corporations by January 1, 2011. And so that, shocked a lot of people. But, within about 6 or 9 months of that, the S&P Toronto Stock Exchange Income Trust Index was actually at a higher level than it was prior to the massacre. And then, of course, we had the big drop in 2008, 2009, and a lot of the individual trusts didn't make it through that, to that period. But better-run companies did. And, when they converted in 2011, about a third of the coverage universe I had at that time actually made that conversion without reducing distribution. So, you buy good companies, that's how you make it through any kind of change. They're going to thrive regardless of how they're taxed. So that's kind of the watch. Another plug for, buying good companies and not just buying, junk on in the hopes that everything works out for them. Another good reason to differentiate. Another good reason not to own or not to invest long-term in MLPs through ETFs or some sort of pool of that nature, because, again, chances are you're going to own a lot of big names that really aren't so good. You really, very, very important to be an individual picker as we move into this phase of the cycle.
Yeah, absolutely. Whatever Congress does, it's important to be selective here. Next question is, are MLPs required to pay out 90% of their income to their unit holders to qualify for the MLP status? And if they are required, how can they reduce their distribution to the unit holder and retain more for the business? I don't know, Roger, you want to take a stab at that one?
Yeah, sure. Because basically what we're talking about here is the difference between earnings per share and so forth, which are generally accepted accounting principles, calculated that way, versus the key metric of master limited partnerships profitability, and it's the same, which is distributable cash flow. It's the same key metric for any flow-through entity that doesn't pay corporate tax, but basically flows through its profits to its shareholders, and then those are the shareholders then are taxed. So that's how they meet that definition, and are many MLPs able to maintain much higher coverage ratios. They may have distributable cash flow that, in some cases, I mean, we've certainly seen enterprise do it many times, cover their distribution by as much as 2 to 1, but certainly by 1.5 to 1, and not every company does that. Not every MLP covers that, has that kind of rich distribution coverage. But that's really what we're talking about when we talk about payout ratios. And it's pretty easy for companies to pay out, to meet the basic tax laws, just as it is for real estate investment trust and yield code and so forth. It's just not the kind of, it's not the metric that profitability is based on, really kind of, in fact, in some cases, it's not even loosely related. I think the important thing for MLPs is to have what's called qualifying income. And that's what basically determines if they're able to continue to be an MLP or have to be something else. And to the extent they have income that's not qualifying, you do pay tax on that as a unit holder, as UBTI, or unrelated business taxable income. And some of the MLPs actually have fairly large portions of that. Others have negative UBTI. I know that's Enterprises had that several years, and that would actually go against any sort of taxation. It really comes only into play when you have these things in an IRA or tax deferred account, and then it's basically the whole UBTI of all your MLP holdings. If it's greater than $1,000 across the whole portfolio, then you wind up having some tax to pay. In practice, though, it's very hard to get that high because, again, just in order to qualify as MLPs, you've got to have qualifying income. So that's really that's the important distinction. It's not that's basically what happens there. MLPs often pay out more than their distributable cash flow. Like I say, that's when the distribution's in trouble and they have to right size it. So really earnings per share is really kind of a meaningless figure to look at when you're from any standpoint on when it comes to MLPs.
Yeah, because the earnings per share contains a lot of non-cash charges like depreciation, and so that's why you'll see sometimes, and sometimes you'll see articles up on, written by people who are saying, this MLP doesn't have sustainable distribution because they're paying out more than their earnings per share.
Yeah.
But that's actually common. There was years where Enterprise Products Partners always paid out more in distributions than their earnings per share. But they were healthy coverage if you looked at their distributable cash flow, which takes out those non-cash charges. So
I would also I'd go so far as to say, when you see an article that in the media that talks about earnings per share and MLPs in the same paragraph, same sentence, that's probably a pretty good article to ignore in terms of whatever else it has to say, because it's basically writing from a position of ignorance that's pretty easy to refute just by having a cursory knowledge of MLPs. But it's there's definitely a lot you have to filter in the particularly on the internet nowadays, various blogs and stuff that's written, and even forums where we appear. Not to name any names, but there's just a lot of stuff on there. And the good news is that if you see things like that written, you can pretty much discard anything else that they say, because they're just not. All they're doing is looking at headlines and trying to write some kind of article, and they make it sound good, and they may have a very good vocabulary, and their diction might be really, really good, but it's basic ignorance of what this asset group is about, and it's a pretty good warning sign that whatever else you're going to read is not going to be helpful.
Yeah, well, the next question here is about BPL Buckeye. I think we've covered that one a lot.
Yeah.
Basically pretty positive on that. So I'll move on. And the next question, it asks about DM, which is Dominion Midstream, SHLX, which is Shell Midstream, and also PBA, which I know is one you cover. That's Pembina, right, Roger?
Yeah, so kind of a mixed bag. I mean, the first two are what we call drop-down MLPs, so or might be called structural MLPs. So particularly Dominion Midstream is in that category, and basically the parent, which is Dominion Energy, used to be called Dominion Resources. Now they're called Dominion Energy, and they have created this MLP as a financing vehicle as they expand certain midstream assets. And one of these that Dominion Midstream is about to start inheriting is the Cove Point liquefied natural gas facility off the Maryland coast, Atlantic states. And it won't be, it was originally built to import natural gas, but now it's going to be exporting gas from the Marcellus and the Utica shale. So it's the cheapest gas field in the United States, one of the cheapest in the world, and now has export capability, and it's a fee-based asset. And so that's how Dominion is managing Dominion Midstream, building fairly large assets. The Atlantic Coast Pipeline's another one, dropping them down in bites to Dominion Midstream. Dominion Midstream then is effectively paying Dominion for that, which Dominion Energy can then use to reduce its debt. They get the lion's share of the cash flows as the general partner and also as a major limited partner. And we as unit holders get a rising dividend. And this is a name that was depressed for a while, and it's now shot up quite a bit. So, that's been good for our Energy and Income Advisor shareholders. We think you ought to stay on there with it. And there's definitely a lot of growth to come. And Cove Point is nearing startup. I think by the end of this year, you'll start seeing gas moving out to primarily to Europe. Also, there's a number of major Asian companies that are in there. So that has the possibility of being upsized, and it's a great asset. So that's Dominion Midstream. If you own it, hold it. If not, please observe our buy target before you buy more. I think it will go a lot higher, but it has come up quite a bit in a short period of time. SHLX, which is Shell Midstream, hasn't done quite as well recently, but same sort of story here. They're getting assets dropped down, a really nice pipeline network owned by Royal Dutch Shell. Royal Dutch just last couple of years made a major acquisition of BG Gas to become the biggest player in LNG in the world, and they are in the process of digesting that, which means they're finding it very profitable to drop down assets to Shell Midstream. So that's another one we'd stay with. Probably a little bit better buy right now in terms of pricing. Then the other name is kind of a little bit different. That's Pembina Pipeline. They're now the number 3 midstream company in Canada. They're so after Enbridge and TransCanada, they're number 3 now. Really, what a great growth story. I mean, this is a name that I've picked up really early part of the last decade, and it was a far smaller company then, but they just made the right move after another. They thrived in all environments. I mean, the Canadian energy patch has definitely been smacked down a lot more than the U.S. energy patch. This is actually one of our international portfolio names, which, as you mentioned early on, it's been a really nice performer for us. And this is a good name. It's actually a little bit above the buy target that we've had, but very good name, growth and income, and a company that has managed to grow by leaps and bounds, even as the Canadian energy patch has been under quite a bit of duress. So really nice name. That was one of the names that was an income trust and converted to a corporation in 2011, kept on raising its dividend throughout. So again, testament to buying good companies. Always, no matter how they're organized, is always a winning strategy for long-term, particularly for us long-term income-focused investors.
Okay, the next question is actually a name that we were talking about just earlier today, which is High Crush Partners, symbol HCLP. This is a name that we recommended back in, I think it was 2013, and it did really, really well. Fortunately, we sold it roughly a month before it topped out in the middle of 2014, and that stock has collapsed. They did just reinstate, after a long period of paying out nothing, they did reinstate a small distribution. This company is involved in the proppant sand mining business. So when you produce oil or gas from a shale well, you use sand, a type of silica-rich sand, to prop open the fractures that are created in the fracturing process. Not to get real technical on how it works, but demand for sand is growing very, very, very rapidly because drillers are drilling longer wells, and they're also finding in many cases that by putting more sand into their proppant, into their fracturing fluid, they get better productivity. Traditionally, Wisconsin and the upper Midwest, but particularly Wisconsin, was kind of like the Saudi Arabia of proppant sand. They have huge reserves of this stuff called northern white sand, which is a very high quality proppant sand. And companies like High Crush had mines up there, and the big cost wasn't really mining the sand, it was moving it down to market. So you have to take it on a railroad all the way down to, say, the Permian Basin in West Texas so that producers can use it. So it's a very good business. Now the demand for proppant sand has come back, but here's my big concern, and this is something we've been watching for a while. It's the rise of what's called in-basin sand. Sometimes it's called brown sand. And basically what this is it's a lesser quality of sand that is found in places like the Permian Basin and can be mined locally. And therefore you cut down dramatically on cost because it doesn't cost as much to move sand from one part of West Texas to another than to bring it down on a long haul route from, say, Wisconsin to West Texas. Brown sand is not as good as white sand just because it doesn't have quite the same properties in the reservoir. But the fact is, and this is something we asked management of High Crush directly while we were at MLPA earlier this year, the fact is that the producers don't really care that much. The reason they don't really care that much is that the uplift in productivity from using a northern white sand is not enough to offset the higher cost of using that type of sand. In addition, most of the productivity uplift comes 5 or 10 years down the road, and a lot of these producers are drilling these wells and then selling the well off to somebody else long before they see any productivity uplift. So most producers are at least mixing brown sand with northern white sand, and High Crush does have a mine down there in Texas, but we're just not sure that there's any differentiation there. We think that their big asset was always their northern white sand asset, and we think that the in-basin sand is going to be taking market share from that. And yes, they have exposure to brown sand, but so does virtually everyone else down there. We just don't see, yeah, they reinstated their distribution. They may even grow it a little bit, but we think that there's very limited upside to this name. I don't know if you want to add to that or
nothing to add. I mean, it's a competitive bit. I think it is. Other than that, this is a name I think people got comfortable with, and maybe some. And I do know some people have stuck with it through thick and thin. Not a lot of reward for doing that. The reinstated dividend is less than a third of what the dividend was before they eliminated it. So, again, it's a extremely competitive business. It's a business that I think that particular company, again, it did really well at $100 oil, but At this level, I think it's a lot of competition.
Yeah, and let's see, the next question is about enterprise products partners. I think we covered that. I mean, that's definitely a name we like.
Yeah. I mean, if anybody wants to read more about it, I mean, we do write about it quite a bit in,
yeah,
in EIA.
we sure do. The next question is actually, it looks like a comment, like Occidental Petroleum, OXY, operates in the Permian Basin. Yeah, that's absolutely true. They have a mixture of international assets and the Permian assets. It's an interesting stock. It's a name we like. They pay a nice yield. They've always had a management team focused on capital return, and they have a lot of undeveloped acreage in places like the New Mexican part of the Permian that we think has a lot of upside. So yeah, I mean, but that statement on the chat here is correct. Yeah, Occidental does operate in the Permian. Another question about Buckeye. I mean, that, and I think we've covered that a lot.
Yeah, I mean, again, we talked. That's another name we've been covering a lot in EIA. We're very much, we're looking forward to earnings coming out as well, and that's going to tell a lot about where they stand.
Yeah, yeah. Yeah, I'm trying to go through some of these ones that are questions that we may have already answered, so that
right.
I know it's just like what, 9:30. It says
on the
East Coast, and
yeah,
some of you all might be looking to go for dinner or even bed. I don't know. But yeah, I'll move through some of these repeat questions quickly here. Well, here's one. Do you have any opinion on OKE?
Yeah, it's one OK. It's again, I think that roll-up merger, like I mentioned early on, has worked out nicely for them. They have they're also located in where they operate is also seeing a nice surge in Oklahoma in particular, is seeing a nice surge in throughput and so forth. The assets they've been a player building stuff. Mexico has actually become a nice market for U.S. natural gas as well. So a lot of good things going on there, and it's a name we intend to stick with for a while.
And there's a question about Kinder Morgan. I think you talked about that a little while ago, but I don't know if you have anything to add to that.
They have announced third quarter earnings, and there really weren't any surprises in there. I think people are maybe looking at or spending maybe a little too much time thinking about the Trans Mountain pipeline and some of the issues there. They have offloaded, I think, the financial risk of that project, even though they have a really nice potential equity stream coming out of that. But that's now all Kinder Morgan Canada, that particular project. It's a project that has a lot of promise, pulling oil out of Alberta and getting it to Canada's west coast. Looks like, I think they're going to get that thing through, but I do think people have really kind of obsessed too much on that particular aspect of the company and not enough about some of the other things that are going quite well for them, and even the new projects such as the Elba Island LNG facility, the pipeline they're building on the Texas Gulf or the Gulf of Mexico coast. A lot of good stuff happening at that company, and they are getting their CO2 division stabilizing there, which is the part of the business that's commodity price sensitive. They're still cutting their debt in line with what they've projected, mainly because they do generate free cash flow after dividends are paid. So they cover their capital spending and their dividend with a lot of room left over just from their operating cash flow. So I think it's a nice value proposition. We had a preferred stock that is mandatorily converts into that common stock in about a year, but we've recommended people make a switch out of that and back into the common again. We had switched from the common after it really cratered into that preferred. We did really well with the preferred. Now we're back into the common again. So I think that's, if you're going to own this name, that's where to be. Great value proposition, but I think we're going to have to, be patient with it.
Okay, the next question about Pembina, which I think you already kind of answered
Right.
at length. Next question I see here is about TK. Yeah, I mean, TK, the parent company, owns tankers. Tanker rates have not been particularly strong. I think you probably got another year or so of kind of an oversupply in that market. TK, there is an MLP called TK LNG Partners, and it's not one that we're really recommending right now, but symbol I think is TGP. But I'd have to say that of the TK group of companies, that may be the most interesting. They have these LNG chartered out under LNG tankers chartered out under pretty long-term contracts, and they're also an example, which we talked about earlier, of an MLP that took its medicine up front. They cut their distribution close to 2 years ago. I think it was December maybe of 2015, and the stock got pummeled. But it recovered because they've got their distribution down to a level where, like Roger was talking about, they right-sized it so much that they had no problems, no concerns about needing to raise capital, pretty much regardless of what their underlying market did. And that decision has served them very well since they cut their payout. So that's probably the most interesting of the TK group that we cover.
Yeah, and I think that's probably another reason why you're going to see more distribution cuts. Just companies just ripping the Band-Aid off and adjusting. We do have, it's a tough business. It is very differentiated, and we do break it down in EI, and we do have some tankers that we actually do like. But
which is actually a similar story. That it's a company that the one we recommend right now, is a name that did cut its distribution a little over a year ago, in the spring of 2016, and they cut it so deeply that they could survive pretty much no matter what happened. They're now actually raising their distribution again from that.
Yeah. And a lot of tankers. Just one more point on tankers. I know a lot of people, and we recommended this name very, very strongly, really up until energy prices peaked, and that was the Navios Partners.
Yeah.
Recommended that pretty strongly up until, but that was a name that we came out of in large part because of that oil forecast you had, and that's anyone's held on to that name. We really pounded the table to sell that name, really, month after month, and it has, again, it's not because management was evil or crooked or anything. It's just they ran into a buzzsaw of expiring contracts, and you could see it coming a mile away. That was just a name to be out of. And again, that's I guess that kind of stage one of this dividend cut frenzy. Now we're in more or less stage two, because a lot of those names like Navios, Seadrill, and so forth, and those royalty trusts are kind of off the map now. But they're a pretty good cautionary tale of what can happen in this business. Just because something pays a dividend doesn't make it conservative. I'm sorry to say, I think that's a lesson a lot of people just keep relearning.
Yeah, and the last question on this section of the chat here is, have you heard about a chemical being used to remove the mercury in the coal utility plants? If so, what is the chemical or substance and the manufacturer? Who supplies it? Do you know anything about that, Roger?
It sounds like like it comes out of a newsletter promotion. I think that kind of really misses the point of what's going on with the coal plants. I think, the bottom line is that here you have utilities. A lot of plants were built during the last big construction phase, which began really in the late 60s, kind of went on into the 70s and so forth. Obviously a lot of nuclear plants were built over that time. But unlike the nuclear plants, which have actually become more efficient over this period of years, a lot of them are losing money in wholesale markets because they're not as cheap as gas, but you can make a pretty good case that they have become a lot more efficient because they've cut into downtime, outage times. They've really learned how to do preventive maintenance. So when something is going to wear out, they're able to replace it. But the coal plants, it's a different story because you just have a different process, and so stuff is wearing out. And now after we're getting to that 40, 50 year time frame for a lot of these plants, they're emitting mercury, and they would emit particulate matter that, again, stuff that gets caught in people's lungs and so forth. But if not for, bag houses and a lot of this technology that has been applied to these, coal-fired facilities. But, it's basically stuff's wearing out on these things. And as a utility, you can go in and build a gas plant and use state-of-the-art, electronics, equipment, everything involved with it, and generate probably more electricity much more cheaply. And you don't have the problem with like mercury. You don't, leaving greenhouse gases aside, you're generating, but even, considering those, you're generating, 40% or less than half of what the coal plant is. So that's the calculus going in for these companies. They can replace this aging plant, which is what's going on across the utility industry. You can replace a plant, meaning, all this generating capacity that was built, 50 years ago, and some even older. And, with regulator support, add to your rate base, which again makes your shareholders happy because that's what pushes up earnings, pushes up dividends and so forth. And you can, eliminate environmental liability. And, a lot of these environmental liabilities are on the state level, they're on the local level. So federal government, no matter what it does, can't, because we do have the system we have, federal system, they can't, they really just can't legislate that these plants stay open. And again, it's just these utilities that are shutting these things down it's not just, if the coal that they can put into these plants is treated with something which will cost them money, particularly because it'd be a developmental, a brand new process. Why do that when I can just, have a share of a pipeline and build a gas plant that's not going to have that problem, period. It's not going to get me sued, with the locals or, the coal ash problem is another big problem. What do you do with the disposal of coal ash? And of course, we've seen some companies get into trouble, even companies like Duke Energy with, these coal ash ponds leaking into water supply and so forth. Big problems, costing a lot of money, but right now they do have regulatory support to clean that up that they wouldn't have by keeping some of these plants open. So, I think that it's definitely making for some interesting copy. And I think, you see this, a lot of energy themes that come out. Electric vehicles would be another pretty good story that really does deserve a lot of debunking. And we've spent some time talking about that, this idea that suddenly electric vehicles are going to replace the entire, vehicle fleet. Same sort of thing, it's very good copy, very good marketing copy, attracts some dollars, but, end of the day, really, that just misses the whole point about the coal plants, which is just basically that there is a cheaper way to generate electricity that's far more efficient, and utilities can add to their earnings by switching to it. So you have companies like Dynegy that does have a lot of coal plants that are arguing against some of these proposals to keep old coal plants open in wholesale markets. It's just not, you're just really, that's really what's happening here. It's not that, coal's not being killed by environmental regulation. It's being killed by the fact that gas-fired power plants in particular, I'm leaving aside, the renewables, which are, mandated by states. Good luck trying to do away with those. But mainly because, again, you can build a gas plant, and if I'm Southern Company, I can actually own a piece of the pipeline that is bringing the gas into my territory, that's allowing me to, shut these coal plants or convert them to gas, where I don't have to worry about any mercury at all. I don't have to treat anything to get rid of, these things are, acid rain gases or whatever you name. It's just more efficient, and it's how I can raise earnings.
Yeah, makes sense.
Yeah.
We only have a couple more questions here, so I guess we can try to move through them quickly.
Okay.
But next question, Roger, up here in New Hampshire, they're hiring big time for the Northern Pass. Are there any opportunities?
Well, I mean, obviously, Eversource is probably a good way to, and that's the utility there. The only problem with that one is always, what price are you going to buy it? But they're trying to get gas and trying to get actually power lines, and all coming down from Canada as well, trying to get cheap energy into New England without actually having to generate it themselves. And then, of course, anytime you build a generating station, you're biting off a lot. But that's been the kind of the basis of the growth. I'm really looking forward to, meeting with the executives of the company at the Edison Electric Institute meetings. That's in early November, and just seeing where they are with some of these projects, because it's become somewhat problematic for them to push these forward, and that's one reason why they're buying the water company as an additional revenue source, so they can fulfill these fat dividend growth projections and so forth. But any of these projects, if they're able to get them through, I think will be a huge plus for them going forward. Unfortunately, I think the gas pipeline that they were building with Spectra Energy Partners, which is now a subsidiary of Enbridge, that one is appears to be somewhat on hold. But again, I think these are definite projects to watch, and Eversource is probably the most conservative way to play that. There's a company called Emera, which is controls a lot of very low cost things like tidal energy and so forth, hydropower mainly, and is in position to start exporting some of that down to New England as well. So that might be another name to take a look at. It's a Canadian company that we cover also in Energy and Income Advisor. We do cover it in Conrad's Utility Investor as well, so you can read about it two places. If you take us up on that what the annual subscription offer from the last slide, but those would be a couple of ideas.
Yeah, okay. The next question is about Dominion Energy Midstream. So basically, with their drop downs.
I like that name. Yeah, for all those same reasons. Yeah.
Yeah.
22%, I think, is their target annual distribution growth rate, and I think they have that really well covered. I just think you do want to watch the price on that one when you buy it.
Yeah, then we would consider it. Yeah, we would consider it one of the better MLPs. Yeah. Another question: will you be speaking together or separately in 2018 around the country? I'm on the West Coast and would come to where you will be speaking. Well, thanks for saying that. We do speak occasionally. It's possible. I would say that if we book a speaking engagement, we'll post it on the website and probably in the emails that we send out. So I just keep an eye on that. Right now, I don't think either one of us have anything scheduled. We are attending a number of conferences, energy conferences, to listen to the speakers and talk to management teams. But I don't know that we've actually scheduled any speaking engagements at this time, but that probably will change at some point.
Yeah, probably. We do have, we have started a new product that is essentially, speaking engagements. And it's called Deep Dive Investing, and we do, you'll be hearing about it, I guess, periodically. But yeah, we do. I think we each do, a full-on presentation on a specialty area. So they're very research intensive, but they're all audio visual. We each do one of those a month, and then we have a updates that we do. We have a whole. It's a relatively new product, so our subscribers are helping us put it together to some extent. But we have a lot of new features we're rolling out with that, and we're pretty excited about it. And one thing that you will see in that product as well is when we do give speeches, we will basically do a record of the same presentation and distribute that for the product as well. I just did that. In fact, I appeared in the local area here. I live in the capital area, so I was actually up in Maryland speaking to a group there, and I took the presentation, recorded it, and we kind of adapted it for deep dive a little bit, so it's a little different. But that's an opportunity you could literally hear us. But I know it's I like press in the flesh myself. I mean, Elliott and I both done that for many years, so we'll probably get out and you'll probably see us out there again. If you do get to some of these conferences, industry conferences where we go, we're always happy to chat with readers who come to those as well and compare notes. I know MLPA is definitely one where we see a number of our friends when we're down there too, and it's nice to get different perspectives from readers and so forth.
We've even talked about doing our own little conference somewhere at some point.
I think that's definitely a possibility too. I mean, not sure exactly where, but again, we will keep you posted on that. And if you do like interacting with us, I mean, we do provide a number of venues for that. I mean, of course, the chats are kind of the centerpiece of that as well. And Energy and Income Advisor, we've done pretty much for the life of the product. We've done one a month where we just had stayed on the not unlike what we're doing right now, but probably even more extreme. Answering any and all questions. We do want to really stay. We have kind of grown up on throughout our careers of corresponding and talking to readers directly. So we value that as much as anyone. And that's something you can. If you do get EIA, you can count on that. Of course, Conrad's Utility Investor, we do a chat every quarter for that one as well. So there's various levels of interaction, but you can always drop us an email or call Sherry, and there's the email right there on the screen you can use. Just make sure you put the 2 T's in there. Capitalist and then times, two separate words, although run together. I sometimes make that mistake when I type it out, but
yeah, and I think I think we're pretty much through the questions here. One person says that they appreciate the 7 p.m. start. Yeah, we're glad to hear that. I mean, this is the first time we've done one this late for us. Both
right.
Roger and I are on the East Coast, and we just got to thinking that, maybe for some of our West Coast readers, usually we do these things at like 2 o'clock in the afternoon. And, for some of our West Coast participants, may not be too keen on, spending 2 hours on a webinar at like 11 in the morning with us. So we thought we'd try a little later start just to mix it up. So I'm glad to hear that you like it. That same person also sent in a very nice compliment about with all the hype and self-serving promotion in the investment newsletter business, you two gentlemen are a breath of fresh air, intelligence, and reasonableness. Keep up the good work and professional perspective. Hey, again, we really appreciate that. Always nice to hear that. We have another person who says that they haven't attended the money shows now for over a year. When we don't appear as speakers, I don't need to spend the money to go. A lot of the speakers are all glitter and all that. let's see,
Yeah.
miss not seeing you at different engagements. I know you're probably too busy to go to these shows anymore. Yeah, well, while this coming year, we won't be doing the money shows. We probably will do some other speaking engagements. Thank you, first of all, for that very nice comment. Much appreciated.
Right.
We try to be substantial, and there are certainly a lot of the huckster types at some of these seminars. But we look forward to doing that type of thing again, or doing some smaller speaking engagements. I'd say one thing is that I know Roger and I both are finding ourselves going to more and more of these energy and industry utility conferences. And, they're often multi-day things where we get to meet with management teams and talk to companies. We don't often, although we don't often present at those industry conferences, but, it's a great research tool for us. And,
Right.
We're spending a lot of time doing that. We're kind of cutting back on some of the, long distance travel to speak. I think that's maybe a better service for the readers and the customers, because you're getting the benefit of the kind of firsthand,
Right.
face-to-face research you can't necessarily get from just reading a balance sheet.
Yeah, I know. Our process is we go to these things, and then we're there. We stay. They might end in the morning, and so we'll stay for the afternoon, and we really try to drill down what we've heard, what we want to feature. We'll go through the presentations that people have made. We'll go through notes and so forth, and we put together a pretty comprehensive report after every time we go to these things. And what you're going to find in those things is the best buys, the things to avoid, some of the major trends in the industry that we see. I can say it's made me a much better analyst doing this. And I think the proof is in the picks that we have, coming out of these conferences. I think they really do constitute an edge, and that's part of that's because we are really familiar with the coverage universes that we are, a lot of the companies we follow. So we do have a pretty good idea of what we want to ask when we come into these things. But a lot of times there are things that just pop up, or themes of a conference that we hadn't thought of. That are really can provide some pretty valuable insights. And sometimes you uncover companies, even in a utilities conference, that's probably more the case, where you'd find a company that you may not have thought of to feature. But, MLPA, often we've talked about, found companies there that we've never even heard of. There's nothing like getting out there and kind of seeing what's going on, and, taking what you learn, and you can read all the industry periodicals you want, or look at all the balance sheets you want, and listen to conference calls and so forth. But it's, there really are a whole range of insights by going to things. And I'm not saying anything that's, groundbreaking really by saying that. That is what people do who, work for Morgan Stanley or another large organization. They have people going out there, but I think that we can actually come at it with different eyes than even those people, I think, too. So it's, anyway, I won't continue on, but as an EIA subscriber, you do get that report every time we go. Obviously, Conrad's Utility Investor, there are other different shows, and we do have that Edison Electric Institute coming up. But we have a number of ideas for this year. I think potential ideas for industry events to attend, and again, those are always great times for learning. But if any of you happen to attend them, we do advertise in advance the ones we're going to. So always happy to have a cup of coffee or something stronger and hash over some investment ideas.
Okay, well, it looks like we got through all the questions. I know it's getting late too. It's it's 10 o'clock here on the East Coast anyway.
Yeah.
So I guess we'll go ahead and end it there. I would say thank you for attending. Thank you, all of you. I see there's several dozen of you still on the call.
Yeah.
After 3 hours. We really do
thank you.
appreciate that. We're really excited, frankly, about the opportunities in the energy business right now. It's been a long 3 years where, we spent, honestly, most of our time being pretty bearish on the energy space and pretty bearish on oil. And we've had to be very, very selective about the names we recommended. Now, though, we feel like we're getting close to a big, epic, generational type bottom in the space. And that there's going to be a lot of opportunity, but you still have to be really selective. There's still a lot of names out there we just wouldn't touch, and that was one of the things we really wanted to get across, and hopefully we managed to get across. In today's webinar, we talked about a lot of different companies as well. If you are interested in taking us up on the special offer, it's only open to webinar attendees. You can go to that website. We are offering a 60-day free risk-free trial to Energy and Income Advisor. If you opt for the annual subscription, you'll also get a free year of Conrad's Utility Investor. If you prefer to order by phone, you can give Sherry a call tomorrow morning at 9 a.m. on to 5 p.m. Just make sure you quote that webinar VIP offer code. I think we got to all the questions, but if you have any questions that come up later, or if you join late, just drop us an email at service@capitalisttimes.com. So with that, I'll end the presentation today. Thanks again, everyone, for attending, and thanks for coming on with me tonight, Roger.
Hey, thank you, Elliott. And it's always a lot of fun, and I hope all of you got something out of it, and I hope you'll give us a shot if you haven't already, and we'll in any case, thanks for participating.
All right, good night, everyone.